show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, a global stock sell-off underway with big tech plunging on fears that a cheaper AI model from China will threaten the dominance of U.S. technology. Nvidia is set for its worst wipeout on record amid the emergence of Chinese AI startup DeepSeek, which demonstrated breakthrough models that offer similar performance to the world's best chatbots at a fraction of the cost. The market action rippling across asset classes, with Bitcoin even falling and the VIX Fear Gauge Index spiking above 20 as investors seek safety.
And amid the sell-off, investors preparing for a big week of earnings results. Four of the so-called Mag 7 companies will report this week, with Wall Street expecting slower quarterly sales numbers. Results from Apple, Meta, Tesla, and Microsoft may add to some of those worries here for stock bulls, with Mag 7 profit growth projected to come in at the slowest pace in almost 2 years.
Plus, investors are also focused on the Fed this week. The U.S. Central Bank preparing to deliver its first rate decision of the year in 2025, with the committee widely expected to stand pat on rates. Traders also watching for PCE data this week, which is poised to show the Fed's preferred inflation gauge is growing at a pace consistent with its 2% target. Nvidia is heading for its biggest drop in history after Chinese AI model DeepSeek sent shockwaves through the U.S. big tech. DeepSeek's recently released AI model rivals some of the world's most advanced AI chatbots, but at a fraction of the cost, according to its creators. The cheaper model's capabilities that calls into question Silicon Valley's surging capex, and those capital expenditures have certainly come to light, especially considering the amount of dollars that companies, especially in Mag 7, are earmarking towards some of their massive AI investments. We're tracking shares of Nvidia here, pre-market, one of the top trending tickers on Yahoo Finance, down right now by nearly 11%.
Yeah, we could be looking at the biggest drop in market cap on record here for Nvidia. When you take a look at the red across the screen, specifically the Nasdaq 100 futures, and the intense selling pressure that we are seeing here at the open, really just goes to show how critical the AI story is to this broader market's momentum, and really what that has done over the last couple of years. When you take account of some of the stories and some of the developments that have come out over the last several days, it is very worrisome here for investors and maybe ultimately what this means. So when you take a look, you have energy stocks actually up on the board. We can start there. When you talk about cost of it, how much investment maybe this puts into question when it comes to the future of data centers, when it comes to the future of energy use, just in terms of how much more efficient potentially DeepSeek could be. We're seeing that reflected in the energy market here this morning. A number of those companies had certainly seen massive gains here over the last several months. Now you're taking a look at some of those chip names. We mentioned Nvidia, but you're also taking a look at Broadcom, Lam Research, KLA, Marvell Technology. Those stocks off substantially here. Some of the weakness across the board just in terms of what this could potentially mean here for that broader AI trade. And then when you talk about Mag 7 and some of those earnings results that we're going to be getting later this week, and Brad, you mentioned it there at the top, the big question is AI spending and exactly what we are going to hear from so many of these larger companies. We got the update from Meta's Mark Zuckerberg last week. He talked about spending up to $65 billion this year. A lot of that driven by AI. We'll get some updates here this week, but this could potentially put even more pressure here on some of those larger cap tech names.
I think it's going to be a larger concern, especially for analysts out there that might come out with some commentary here today and during the session about how much this actually impact those very companies that you were just mentioning in their overall growth trajectory. Because as you think about where they're selling into, and of course, we still have to think about where there are products that are curbed to being sold into China. So that is a core part of this story here, is really where DeepSeek may be able to entrench itself in a region where there are already some of the curbs on specific types of products that can go into the Asia Pacific area and specifically China. And then additionally, outside of that, how those companies can ramp up growth both here in the U.S., but then additionally in either Latin America or the EMEA region as well here, and where that can kind of offset what the impact, the detriment would have been by them not being able to sell into China, or favorability going towards DeepSeek as well. So kind of a market share portion of the story here as well that we're thinking, and I think that investors are trying to get ahead of.
Yeah, exactly. And I think when it all comes down to cost, and investors are just very much trying to figure out whether or not it is as cheap as it seems right now. At least it seems that we are hearing from DeepSeek just in terms of the cheapness here to train its large language models and how that stacks up to some of the large language models that we're getting from OpenAI, that we've gotten from Anthropic, and how big of a potential disruptor this is going to be to that AI investment story. But again, so I think the question here investors are asking is whether or not this is a bit of an overreaction as to what we're seeing, especially more broadly here amongst the markets, or whether or not this is something that is certainly going to disrupt some of that momentum that we have been seeing. We're here to talk about that are two people that know much more about this, two experts on this thing. When we talk about DeepSeek's progress here, what it means for US AI giants, when you talk about big tech, we want to bring in Dan Newman. He's Future Group's chief strategist. We also have Stacey Raskin. He's Bernstein's managing director and senior analyst. Great to have both of you. Stacey, what do you think? How worried should we potentially be, or how worried should big tech be about this development?
I'm not that worried. I think there were a few things that have caused panic over the weekend and clearly in today, right? I mean, the headlines, the initial stuff, the takes that came out basically said, oh my God, they've duplicated OpenAI for $5 million. They did not duplicate OpenAI for $5 million. And we can go through why. Number two, I don't want to discount the models they built are fantastic. They really are. And they've pulled a number of levers on efficiency that are great, but what they're doing is not miraculous either, or unknown to any of the other top tier AI researchers or AI labs that are out there. The training efficiency and everything else that they've done, it's very explainable and kind of obvious if you look at the types of model structures and everything that they're using to build this. Long as it was not a crazy thing, and I don't think it's unknown to anybody else. And then finally, you got to ask, like, is this good or bad for infrastructure? I am not of the belief that we're anywhere close to the cap on compute needs for artificial intelligence. You have to remember, I'm a semi guy. I view cost reduction as a good thing. For 50 years, every 2 years, costs in semiconductors got cut in half. It wasn't a bad thing for semiconductor man. It was a good thing for semiconductor man. And so I'm of the belief that, like, if you're freeing up compute capacity, it likely gets absorbed. I mean, you have to remember, costs were going up to do this training, everything like 10x a year, like for the last several years. I mean, that's not something that you can keep doing. We're going to need innovations like this if you're going to be able to keep things going on a trajectory. And so I actually think it's overblown. I understand why all the panic is going on. It's going to create a rich tapestry for debate as we go forward here, but I actually think it's overblown. I actually didn't think that this is necessarily bad news. I don't think DeepSeek is doomsday for AI infrastructure. And Dan, like, I don't know what your opinion on this.
Well, Stacey, point well made. And Dan, as we're thinking about this too, with all of the mindset around what OpenAI has been, what it is right now, and where it's continuing to grow, it's not like we weren't expecting more entrants into the marketplace and more competition. So what makes DeepSeek different? What's the significance of this platform or this language learning model that is outside of the realm of belief for so many who are already operating in this industry?
Yeah, from a technical capacity, the way they were able to use reinforcement learning to use less tokens to be able to train such a large model and be able to replicate such consistent or high quality outputs, in many cases, some of their outputs are actually very interesting, was really interesting, and I think it did create shockwaves. I am in line with Stacey. I've been on a bit of a tear across X. First of all, when did we decide that we're going to just believe a paper that comes out of China? There is a continuum of thoughts here, but there are leaders like Elon Musk and Scale AI CEO that have basically come out and said they probably have 50,000 H100 GPUs, maybe more. And so it's not obvious right now that everything they're sharing is exactly accurate. And it's not unlike China to potentially try to play a little bit of psyops with Americans and the markets to see how we would react. I think the progress is good, though. As Stacey said, look, if we can get this Jevons paradox thing where we get more compute, it's not going to stop and people aren't going to be like, we need no more. What's going to end up happening is companies are going to move faster. And I'll make one more point, is that ultimately we've looked at the possible bubble around AI, around too much cost on CapEx and not enough consumption or revenue generated by these ISVs, platform companies. Well, guess what? If we can create models more inexpensively, if we can use compute more efficiently, these SaaS providers, the Salesforces, the ServiceNows, the Microsofts, those companies that we're saying they're not driving enough revenue. They'll be able to build their models cheaper. They'll be able to create solutions with less overhead expense, and they're going to drive more EPS. So I just think the market's completely missing this one. And the fact that we're believing China just with their word, to me, I think that needs a little more inspection.
Stacey, does this at all shift that longer term narrative surrounding efficiency, surrounding spending?
No, I mean, we need efficiency. So, I'll go back like at the Hot Chips conference a couple of years ago. Hot Chips is like an emerging chip conference. They have it at Stanford every August. And I think it was 2 years ago, Nvidia's chief scientist, Bill Dally, gave the keynote. And he was talking about, in this context, it was GPU performance improvements. But think about that in terms of compute improvements. And he was talking about how, like, over the prior 10 years, they'd improved GPU performance by something like 1,000x. And it was a variety of things. Some of it was process tech. Some of it was lower numerical precision. Some of it was sparsity and architectures and all these kinds of things. But 1,000x. And what he said is, over the next 10 years, we want to improve it by another millionx. Again, if you sort of have a view of where the compute requirements need to go to achieve some of the things that everybody in this industry wants to achieve, we need efficiencies from wherever they're going to be coming from. And so, no, I don't think it changes that long-term like narrative. And in fact, we've even seen this. You have to remember, DeepSeek started to release like the V3 model, not the reasoning model, but the chat model came out in December. Like this is not new. And even just last week when all this was coming out, we got a number of data points that clearly show, at least at this point, spending's going up, not down. So Meta significantly increased their CapEx. We got the whole Stargate announcement, $500 billion, like fine. Even China announced it was like a 1 trillion RMB. It was about $140 billion US AI effort that they're going to be putting into place. And so clearly right now, I think spending is still continuing to accelerate. I don't think that this has to stop that.
Just lastly, while we have you, Dan and Stacey, you're welcome to answer this very briefly after Dan. But for investors that have been trying to figure out where the dip buying opportunities are and have been waiting for a dip, this seems like a pretty massive dip that we're seeing here going into the open. Should investors feel comfortable buying in on some of these names with this dip?
The secular trend isn't changing. And so AI, I see this as an opportunistic moment. Like I said, I actually think some of the second and third network effects that have come up, but not as much direct ability to ascribe value from AI. So I look at the SaaS players, I look at some of the platform players and the cloud players that have been making big CapEx spend. Jevons paradox. I think we're going to see more demand. We're going to see more interest. I think companies can move faster and they can drive EPS expansion. So I'm not bearish on this at all. And while people are extremely negative, the FinTwits are going crazy, I think calmer minds prevail. And we also, like I said, Brad, we need to investigate all of this sort of data here and make sure they've really done what they've said with what they've said. But I think we're in a good position. I don't think this is a long-term dip.
Yeah, Stacey, quick comment.
Yeah, I mean, look. So everybody's always looking for a dip. Like we've got a dip. Like we haven't changed our views on any of these stocks. This doesn't change it.
Dan, Stacey, thanks so much for taking the time ahead of the opening bell here. Appreciate it.
You bet.
The week starting off with a steep sell-off in stock futures, the Nasdaq headed for a nearly $1 trillion market cap loss if declines hold into the open. This is off the back of the release of a China-based AI chatbot, DeepSeek, that rivals ChatGPT while touting a lower cost. And we have a lot of market-moving headlines on the horizon this week with a slew of economic data, including the Fed's first decision of 2025 here. Plus, you've got more than 100 S&P 500 companies reporting earnings this week, including 4 of the Magnificent Seven. We've got our very own Josh Schaefer here with us with what he's excited about and what you're hearing from strategists as well about the steep sell-off.
Yeah, Brad, so we had a lot to talk about going into this week, and we didn't even mention President Trump in that intro, right, too? So we could throw that into the mix as well. We're getting tariffs on February 1st, which is Saturday. And then instead we wake up to a stock market sell-off, right? And so I think what I'm sort of hearing and reasoning with this DeepSeek-driven sell-off is we've been talking about the risks of concentration in this market and the risks of the big tech AI rally for really probably over a year now. What I don't think we've had is tangible reasons why Nvidia earnings are going to fall off a cliff or why Mag 7 earnings are going to fall off a cliff. When you look at what the market is priced for this year, we've talked a lot about this earnings story of the 493 are going to catch up to Mag 7, right? Well, look at consensus estimates. Earnings are actually supposed to accelerate for Mag 7 in Q2 and Q3, right? We had a chart in our newsletter this morning showing that. And when you think about the overall story, Mag 7 earnings are supposed to grow by almost 25% in Q3. We're still in a market that is pricing a very good outcome for the Magnificent Seven stocks and big tech as a whole, and that has been a key driver of this market. And like I said, if you asked someone 2 months ago and they said the biggest risk is Nvidia earnings disappoint, well, you say how? They probably didn't have a great answer, right? Well, here is an actual tangible answer that investors can feel, touch, see, use. They can go online and use this technology, and it's a reason for why earnings might disappoint. I think a lot of the other risks we've talked about in this market, whether it be the Fed or whether it be Trump, you can sort of lay out very clear reasons why that could be bad for stocks or bad for the economy and then bad for stocks. For Mag 7 and big tech, we haven't had a lot of reasons, and it feels like over the weekend we finally got our first tangible reason.
Yeah, we certainly did get a tangible reason. I think the big question is how much tougher this is going to make this earnings week here, or earnings couple of weeks here, as we do wait for more of the Mag 7 companies next weekend, and then of course Nvidia in a few weeks. Josh, how are investors or strategists, I guess, stacking this up against the Fed and the threat of more tariffs and ultimately the impact that is going to have? Yes, obviously earnings very much, you can make the argument, makes a lot of sense, the biggest driver, most important right now to that overall market narrative. But the Fed and tariffs certainly do play a part into that macro view.
They do, and they maybe play more of a part in the tomorrow view, right? And I think that's why you saw the market trading on what President Trump has been saying so much last week, because that's a soon story, right? If we're talking about DeepSeek really growing here and becoming an AI competitor and taking market share from Nvidia, I don't think it's happening tomorrow. I think that's happening down the line, right? And we need to learn a little bit more there. But tariffs, we're supposed to get some solid news on tariffs this week. And then we'll have something to sort of price in that maybe we hadn't priced in, right? The Fed, we're gonna have more tangible evidence of where they're headed in 2025. Maybe, or maybe Fed Chair Powell doesn't say too much on Wednesday, but we might actually know a little bit more about the interest rate path come Wednesday. So yes, Sean, I think obviously hyper-focused on the news that happened over the weekend as we enter the open here on Monday morning, but I do think we're gonna be teetering through several different key drivers as the week goes on. I don't think it's just gonna be DeepSeek all week. Yeah.
I think Powell is chilling for a couple months here. I mean, the probabilities are pointing out towards the back half of this year, midpoint of this year. So,
he wants to be chilling.
Yeah.
I think Trump isn't going to waste any
pressure
time
off,
in
right?
terms of some of the criticism that he's going to lay
still
out.
got to see how the economy ingests that too. So,
Totality of the data, guys. We got to wait for more to come in.
I'm data dependent.
Josh, thanks so much. We're just about 12 minutes here ahead of the opening bell on Wall Street. Again, you were looking at a sea of red across the board. You're taking a look at some of the movement here on your screen, but actually we're looking at significant more moves than we are seeing up there for the Nasdaq futures. You're looking at the Nasdaq 100 here, looking to open off almost 3.5% to 4% here. We're looking at a massive wipeout here. A lot of that selling pressure being led by some of those larger cap tech giants here. You've got the S&P also on track to open the day off just about 2%. The Dow futures under a bit of pressure. Lots of that selling obviously being driven by the developments over DeepSeek, the Chinese AI model, and ultimately what that poses, or the risk that then poses to that broader AI trade that we have certainly seen gain momentum and very much carry the market, drive the market here over the last several years. So again, we are seeing a selling across the board as investors try to digest just whether or not this puts into question that U.S. tech dominance story that we've been talking about when it comes to AI adoption and what that looks like here in the coming years. We'll be right back.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session. We've got Yahoo Finance's trending tickers page. It's lighting up this morning. You should be on there. But stay with us for a hot second here. Let's talk about Nvidia plunging as China's AI model DeepSeek sparks a sell-off in the chips sector. The drop on track to erase more than $279 billion from Nvidia's market cap. That would mark the biggest drop on record for the stock. As we're taking a look at shares this morning, they're down by nearly 12%. And it's leading the Nasdaq Composite lower as well. Looks like the Nasdaq is down right now in the futures at least by about 3.5%.
Yeah, certainly. When you take a look at the magnitude of the drop that we're seeing in Nvidia, that very much just really points to the fact that obviously this is being taken very seriously by Wall Street. Whether or not the reaction is a bit overblown, we just talked to Dan Newman, we just talked to Stacey Raskin, two analysts closely covering the space, and they very much made the point that they actually think the AI investment story is still intact. They see this reaction here this morning as a bit overblown when it comes to some of that panic that we are feeling here from the street. But again, you can't ignore the fact that Nvidia, that market darling here, over the last couple of years is down 12%. And ultimately the impact, given the size of this company, what the impact is having here on the major averages. Nasdaq 100 futures substantially lower here this morning. You're taking a look at the S&P on track to open off over 2%. You're taking a look at many of those chip-related stocks, many of these names that have been riding on the back of some of that excitement on the tailspins here of Nvidia. That's actually, they're all pretty substantial. You're looking at Broadcom off just about 11%. You got a name like Marvell off 12%. Energy sector is also caught up in the sell-off that we're seeing here this morning. So again, when you look ahead to the rest of the week, maybe what exactly this tells us about the volatility that we could see, Brad, when we hear from more of those big tech, when we hear from big tech here for the first time here for this earnings season, maybe ultimately what those AI spending plans look like. Any more insight there, especially what we're hearing from Alphabet next week, that's going to give us a better idea just where this all stands.
I mean, we're at what, 7-8 consecutive quarters where Nvidia has been the barometer for how well earnings season will or will not do. And what Nvidia says, as to Nvidia goes, so too goes the market, is what we've seen. But for what we've seen coming into the start of this year, and Nvidia really leading the chatter to begin things, Jensen Huang at CES, we're not going to hear from Nvidia again, most likely, until February 26th when they report earnings. So a lot of time between now and then for the market to really try and price in ahead of what those results are, its anticipations for some of the new market entrants in DeepSeek, as well as just the realization that, oh yeah, it's not a zero-sum game or it's just a one-player game here, regardless of the fact that they've entrenched themselves so much and whatever chips fall off of their plate typically tend to land on AMD or some of the other semiconductor companies. It's still Nvidia that this market is gauging its successes and its losses based on.
Yeah, very much. And when you look ahead to the next couple of weeks, big tech earnings is going to be in focus. We're already expecting the slowest profit growth that we have seen in almost 2 years here in the coming days. So you add this layer on top of that, it could be a very tough week or set up to be a very tough week for some of these larger cap tech names, especially when you take a look at the hyperscalers. Any more info that we're going to get or insight from names like Meta, insight from names like Microsoft, and ultimately what that AI spending landscape looks like here, given the massive spend that we have heard from these companies over the last several quarters, and given that update that we got from Zuckerberg last Friday. Clearly that is going to be front and center here for investors this week. All right, let's take a look at AT&T beating fourth quarter estimates, topping subscriber expectations, demand boosted by seasonal promotions and also bundled offerings. The CFO of AT&T, I had a chance to speak with him just a few moments ago on the heels of their earnings release. And I asked him what he's seeing about the consumer. And he very much reiterated the fact that the consumer is healthy. They're seeing strong demand for goods and services. He also went on to say that when you look back at 2021 and 2022, the last couple of years, he described that environment as very frothy. He was saying that he expects to see this continuation of normalization, what we have seen here over the last several quarters, to continue. But again, a very upbeat quarter here from AT&T. You're looking at gains of almost 3%, especially given the broader macro picture. Gains of 3% on a day like today is extremely impressive. I also had a chance, Brad, to ask him about the Trump administration, maybe ultimately what that signals here for AT&T, the impact that's going to have on AT&T. AT&T, and he used the word hopeful twice. He said that he's hopeful that the new administration is going to be able to accelerate some of the progress that the company has seen on decommissioning of its legacy networks. He also went on to say that he's hopeful of quicker momentum under Brendan Carr. So again, a couple of things to keep in mind when we talk about AT&T transforming its business, very much growing. They talked about this new era of growth here in this earnings release. And again, it looks like the street very much buying into that this morning.
Yeah, well, what they have to be hopeful for is that the current administration now in Trump and President Trump and his associates also prioritize connectivity. And that is going to be a major consideration, especially given the growth trajectory that CEO John Stankey is talking about within his comments within this release, saying that customers and shareholders can look forward to receiving even more value in 2025 as they expand the country's largest fiber network, modernize their wireless network, grow their business, begin share repurchases as well in the second half of the year. And so all those things considered, expanding that connectivity also relies on the government also buying into the expansion of the network that both AT&T, Verizon, and some of the other smaller players are looking to build out as well. Finally here, let's talk about SoFi. SoFi Technologies beating fourth quarter estimates, but guidance for the first quarter profitability coming up a little short here. Still, its financial services and tech platform segments made up a record 49% of the company's adjusted net revenue here. Shares of SoFi right now, they are lower by about 9% here this morning as we're continuing to track. And it is one of the top trending tickers that we're tracking at this point, just going into the bell here.
Yeah, exactly. The financial services and tech platform making up a significant chunk of that adjusted net revenue. The reason why this matters, we certainly have seen SoFi try to move and shift, reduce its reliance, I guess is the best way to put it there, on its lending business, those types of businesses that tend to be a bit more cyclical. Although a lot of the reaction that we're seeing this morning, this drop of almost 10%, yes, within the broader context, it's important to point out when you look at the selling pressure here across the board for the broader markets, but very much a lot of this has to do with that weaker guidance that we're getting, or disappointing guidance, I should say. It's certainly reflected in share prices here this morning. Keep right here on Yahoo Finance. We got much more of your market action ahead. Opening bell when we come back.
All right, there's a tasty little look at the opening bell. You've got the New York Stock Exchange on your left side, Shake Shack ringing the opening bell there. And you've got some funfetti in the air at the Nasdaq in Times Square, where CleanSpark is ringing the opening bell. And thus, we have begun today's trading activity. Let's take a look at the Dow Jones Industrial Average as we kick off this trading session. The Dow is right now down by 0.7%. The Nasdaq Composite, we're going to wait for this to calibrate here, as we've seen that in futures down by 3.5%. And there we see it finally calibrating here. That's down by 3.5% as we are seeing, and we'll populate this chart here for you just for a hot second as we're lingering on this for the Nasdaq. And you're seeing some of those declines and reversing some of the positive move that we had seen last week and then, well, over the past 5 days at least. The S&P 500, you're also seeing that down by 2% to start off today's trading session. I want to take a quick look at some of that sector activity as we always do here. 11 sectors, we've got them lit up here on the board for you. The worst of the decliners, this should come as no surprise, technology right now. XLK is down 4.3%. You've also got staples, though, in positive territory, trying to do its best to counter some of that negativity that's swirling out there around in the markets right now. That's up by about 1.8%. A few other gainers as well. So it's not all bad news, but certainly in the world of tech, it is. Let's take a look at the Nasdaq while we may here. You've got a lot of lake red here, deep red, maroon 5, if you will, on the screen here as we're seeing Amazon, Google, Nvidia, Microsoft, and Broadcom all down right now in deep red. And then additionally, we'll toss in ASML as well. That's also deep in decline. Apple, hey, it's up. Don't call it a comeback yet, but it's up by about 1% here. Why did I say that? Well, let's take a look at what's been transpiring over the course of this year. The company has been down by nearly 10% here, so we'll continue to track that and see if they can start to mount some type of momentum here. For a little bit more on today's tape, let's get on over to Yahoo Finance's Jared Blickery with a deeper look at what's moving. Hey, Jared.
Thank you, Brad. Apple caught my eye as well. That's looking nice after that bounce over the 200-day moving average. But we got to talk about the markets that we have before us. And the S&P 500 is now down 1.8%. Let's just put a year-to-date chart in here. You can still see that it's holding on to gains of 1.74%. But this is the worst opening drop for the S&P 500 since August 5th of last year. That was the so-called Yen-Mageddon trade, and that had to do with Japan. That was outside of things that were going on in the U.S. for the most part. And it's interesting to me, the weakness that we're seeing here in equities today is really not the Trump trade. These are just inherent to the bull market that we have kind of established over the last few years, and the importance of the AI trade is going to be fleshed out here. Here's a 10-year T-note yield. It is down 10 basis points, so that's actually moving in the right direction for risk markets and to support risk assets right now. You can also see the U.S. dollar index is down, and I'll put a one-year chart on that. We can see here are the highs. Those are multi-year highs, and we are well off of those, so that's supportive. And then if we go into the sector action, it is not even a sea of red. We got two sectors in the green, staples and healthcare, and you can see the losses really centered around tech, but also utilities. Why utilities? Because guess what? That became an AI trade last year. So a lot of those names which had kind of ridden that FOMO, that hype of the AI, are getting a little bit of a beatdown today. I want to check in on the, before I forget, let me go to industrials here, because according to Mike Zaccardi, and I double checked this, they just came off their best 2 weeks in a couple years. And in fact, this covers the entire bull market since the beginning of October in 2022. So that tells me that there are other things, there are other sectors that are waiting to come into the fore, even if we see tech fail. Now, can the rally survive without tech? That is the magic question here, and we're going to find out that answer eventually. Back to the Nasdaq 100, just want to show you how Nvidia and Broadcom now. Broadcom's down a bit more, down 14%, really leading things down. And I'll show you the semiconductor space. We got a few green spots here: Intel, Microchip, Texas Instruments. But for the most part, we're seeing some pretty steep losses. I'd also throw in Marvell. That's down 14% as well. And I'm going to end here on Bitcoin, because that is a risk asset that is seeing, and it's getting caught up in the risk-off environment that we're in right now. This is a one-year chart, and you can see we are still very, very close to those record highs. I'll put a 5-day chart on, but that's not coming up. Let's see about a 10-day chart, and you can see this is, in fact, the worst day that we've had in 3 weeks, but still holding 100,000, so really not that much concern to those in the medium or long-term frames. Shauna?
All right, Jared, thanks so much for breaking that down. It's time now for today's strategy session. And again, stocks plunging at the open. Big question here is whether or not the sell-off is overblown or if this is the start of a market correction. We want to bring in Seema Shah, Principal Asset Management Chief Global Strategist. Seema, what do you think? How should investors be looking at this?
Hi. Well, look, I think the first thing to say is there's still so many question marks at the moment. A lot of questions that need to be answered before investors can really take an educated decision on how they want to deal with their exposures. Um, right now, I don't think that we're at that point when we can start talking about correction territory. But I think it has, given where valuations are, we came into 2025 with investors quite rightfully a little bit concerned that things were looking fairly frothy, particularly for those mega cap tech names. And this is a good reminder that, look, global diversification really is key. I think the macro environment at the moment is constructive, which means that there should anyway be a broadening out away from some of those mega cap tech names to other sectors. So it's important right now that investors be looking at what is a broad universe of opportunities, not just in those Mag 7.
For those who were sitting out there and sharpening their pencils for any buy on the dip opportunities, we were mentioning and discussing this earlier. This is that dip. They got their dip. Can they feel comfortable, though, buying? And given some of the question marks that you were raising a moment ago, what answers should they be looking to solidify?
Well, I think the first thing to say is that, there have been a lot of people waiting on the sidelines, waiting for some kind of pullback because they know that the environment is constructive. We still think that earnings growth from a broad level, but also for the tech firms, is going upwards, which is generally it's a good environment for equities to continue rising. But today's pullback, I think, given where the question marks are, it's probably not the time to be dipping straight back in. You want to see, is this company, what is happening with the costs? How much of news can we get in terms of whether the Chinese government has maybe contributed? How sustainable is this? This isn't also the first time that there have been these kind of almost competition scares for some of those big cap, the mega magnificent seven names in the past. And a lot of those competitions have suddenly withered away. So I think it's still really early days, but I think the thing that investors can hopefully sit back on and enjoy is that, look, if you do have exposure to other sectors such as financials, which benefit from not only having obviously limited exposure to this issue, but actually limited exposure to some of the other factors that are weighing on uncertainty for investors today, including trade tariffs, they can be quite positive that, look, the environment is still for strong growth, and at least those names can continue to deliver positive returns.
Stephen, just given the sheer size and scale of big tech, obviously we've been talking a lot about diversifications and broadening out of the markets, especially when it comes to earnings season. But a move like this that we're seeing this morning, it very much points to the fact that just how critical tech is here to this earnings season, the overall health that we're going to get just in terms of those growth rates, and then also just the overall trajectory and the narrative out there in the street right now, right?
I mean, I think it's true. And, I think everyone has become increasingly concerned about how concentrated the market is. And in some ways, you're right that, a lot of the trade has become very much one-sided. What we've seen last year is that, of course, there was always talk about a broadening out, but every time that maybe the mega caps took a bit of a sit back, they came straight back in again, which has continued to draw more and more investors in. As I said, look, the economic environment is still very constructive for earnings across most sectors. That's really key. The other thing to take back from this is that, look, if DeepSeek is everything that they're saying, this is ultimately positive for broad productivity around the world for all sectors. So, there is some good to be taken. Maybe it does put some question marks around those very key tech names, or his key tech name for the US. But it certainly isn't necessarily the end of the story of US exceptionalism and productivity.
As we're evaluating DeepSeek, and that is the of course, conundrum du jour, we also have to think about the Fed and what that decision is going to hold, of course, later on this week as we start to get inclination, or at least can believe in what the Fed is projecting for the rest of this year. What most notably would you be paying attention to in the language that the Fed is using, especially as the markets are weighing that in the balance?
Yeah, sure. And I think the first thing to say is that, we're dealing with uncertainty as investors, but the Fed itself is also dealing with a lot of uncertainty, specifically with regards to what are the inflation pressures that could emerge over the rest of 2025. I think investors be realistic that Powell is unlikely to offer any clear answers at this stage because they need to see what are the policies, what is the implementation, and then after that, what is going to be the impact specifically to inflation expectations and growth. These are all very big question marks. So I actually don't expect us to hear much. We could hear maybe some comments reiterating that rates are quite restrictive, which would give us an indication that at least the bias is still for lower interest rates. But I think the jury is still out. And what we're going to be watching for over the next few weeks is not just Fed speak, but really an extra emphasis on what are the inflation numbers going to be and what are the labor market data going to be. Those are the two things, and actually I think are more important even than the news coming out today about DeepSeek.
Seema, appreciate the time just after the opening bell. Thank you.
Thanks.
As we head to break, we're taking a look at some of today's biggest laggards. You've got Nvidia, Constellation Energy, and Vistra all on your board right now, all of them down double-digit percentages, the deepest of which, Vistra, down 20.5% at this juncture. Nvidia, you're seeing their shares lower by about 10%. This would potentially be the worst market cap decline day for Nvidia, depending upon how things hold going into the rest of the session here. We got a lot of time left on the clock. And then also we're taking a look at Constellation Energy. That is down 14%. We've got much more ahead on Morning Brief.
Bitcoin popping back above $100,000, but still down as investors shift to safe havens amid the tech sell-off. This volatility coming just a week after Bitcoin reached a new all-time high, just above $109,000 on President Trump's inauguration day. Joining us now with more on what this ultimately means here for the crypto landscape, we want to bring in Andy Bear. He's at CoinDesk's managing director. Andy, it's great to have you here on set. Just given the narrative, given the selling pressure that we're seeing today, the fact that Bitcoin's still holding right around that $100,000 level, what does that tell you?
It's super significant. I think that it means the liquidity is great. It means that the market is starting to detach the Bitcoin narrative, the macro store value narrative, from the growth narrative of many other tokens. It sold off overnight, and there were liquidations in the perpetual futures market, which is not as disastrous as it sounds. Liquidations happened. The funding rates started to turn negative. the Bitcoin market now is searching for a surprise reason, right, to go and hit all new time highs. We had $1.6 billion of inflows into ETFs last week. MicroStrategy announced this morning that it bought another 10,107 Bitcoin. Normally these things would be enough to propel a rally up, but these aren't surprises. This is just supportive. So we may have to be a little bit more patient. We'll see what the Fed has to say. The Bank of Japan raised last week, created a little bit of a headwind. So we'll see. But holding 100 in a tape like this is pretty impressive.
I don't want to project a crypto winter out there, but it's natural to think about, okay, if we are looking for reasons to get to a new all-time high, then there's going to be that period of waiting to see what the new administration, what the regime is talking about in terms of prioritization for Bitcoin regulation. What would be the pillars to that regulation that would satisfy Bitcoin holders and the currency out there as well, and ultimately push us to that next market?
Yeah, for Bitcoin, I think some people were expecting the announcement of a specific Bitcoin strategic reserve, which I think may be a little bit ambitious. I didn't really know what that means, and so I think there maybe wasn't disappointment, but again, a lack of surprise. For Bitcoin, I think you're going to see more sovereign, corporate, institutional, wealth, retail adoption. Regulatory stuff is kind of in place. So I think you're just going to look for slow and steady. I liked your point earlier about winters and summers and seasons. Last year, we had these 2 quarters of very good momentum that had a lot of breadth. CoinDesk 20 names were up, Bitcoin was up, and then the other 2 quarters were kind of flat. So the asset class is young enough. It still enjoys a bit of momentum where things kind of get together. That most recent one for crypto really kind of ended on December 18th at the Fed meeting. So we're waiting to see when the next quarter starts to perk up.
What, in the absence of regulation, are the first coins that would actually see some type of flows out, as it's not like the administration's talking about prioritizing a Dogecoin strategic reserve or even a Ripple strategic reserve as well here, even though we've been tracking Ripple prices here in some of the inflows that's seen over recent weeks too, and outflows over the weekend.
For sure. Think about the new leaders at the SEC and CFTC. Think about the stablecoin regulation that might come this year. Think about payments. Think about banks with SAB 121 going away, being able to custody digital assets. All of this stuff is supportive for the industry. Maybe for the easiest way to think is a lot of these things, stable coins, and not Ripple in particular, but many other stable coins, meme coins, Trump, they all have to sit on other blockchains. So one great thing to watch is just look at the blockchains. Look at Ethereum, look at Solana. Sui is going to enter the CoinDesk 20 index on the 31st. That's a new entrant. So these growing blockchains, which are bringing in energy and bringing in both kind of fun activity like meme coins and more serious activity like stable coins, that's a great thing to keep an eye on, and just watch the index price. But put Bitcoin again in one category of a macro asset and think of all these others as growth.
Andy, real quick though, when you take into account the correlation that we've seen between Bitcoin and the Nasdaq, obviously there's been periods of decoupling, but just given the news that's out today, is that very much the driving factor, do you think, of some of the price moves that we will see here in the crypto market, just in terms of what we're seeing maybe more broadly within big tech, at least over the coming weeks?
It's a great question because people sort of point at Bitcoin on days like this and say, wait a minute, I thought you said this was a flight to quality asset. And we say, no, it's a store of value asset. It is still a very young asset. It's, for most people, a discretionary asset. So when capital comes away from things like this, flight to quality assets are going to remain US Treasuries or things like that, or cash, right? Bitcoin as a store of value has a completely different proposition. I like the resistance. The rest of the sector, the CoinDesk 20 names are down 10% over the weekend. Bitcoin looks like it's popping back up over 100,000 into its kind of current comfort range. So I would hope and look for it to detach a little bit, not to the point where it goes negatively correlated with NASDAQ names, but to the extent that it actually becomes kind of a quality name within cryptocurrencies.
Andy, thanks so much for joining us here on Set today. Appreciate it.
Thank you.
Absolutely. Coming up, everyone, what investors are expecting from Tesla's earnings later on this week. Plus, Doge, the Department of Government Efficiency, as you may know it, is hiring. What President Trump's Department of Efficiency is looking to accomplish next when we return. Tesla will report fourth quarter earnings results after the bell on Wednesday. The stock is a beneficiary of the post-election rally, rising over 60% since November 5th, but it's taken a little bit of a breather in recent weeks amid worries over slowing demand and a rollback of pro-EV policies. Apart from the actual results, this will be the first earnings call since President Trump was reelected and sworn in, and his buddy you see there on screen, Elon Musk. Those two, they certainly have been chatty as of recent.
Yeah, they certainly have been chatty. I think the big question is how much of that AI story, the AI narrative, the robotic story, whether or not that's really once again going to be able to overshadow some of those challenging and concerning trends that we have seen within Tesla. When you take a look at the sales miss, when you take a look at those projections that we are getting from the street, clearly it points to the fact that Tesla is under pressure when it comes to the EV business. We've seen that reflected in the stock over during President Trump's first week back in office. You saw the stock drop just about 4%. When you take a look at the last month, you're looking at declines there for shares of just about 12%, and you're looking at an additional 2% here this morning. So there's clearly some worrisome trends inside of Tesla, but again, very much the focus on so many of these bullish calls that we've been covering time and time again here at Yahoo Finance, the increasing of the price targets that we've seen from names like Wedbush, that we've seen from Piper Sandler, very much calling out the AI robotics trend. They see that as really being an overarching theme and the driver here of the stock in the longer term. And at least for now, it's able to offset some of those concerns that we have seen within the EV business. But I think the question is whether or not the market's going to agree with some of that sentiment there on Wednesday.
You know, just taking a step back and thinking about what the ultimate value proposition is for Tesla, and it really is them being able to bring down the rate of accidents, the rate of crashes, increase the amount of data that can then lead to perhaps less insurance costs for car owners as well. That points back to full self-driving. And if they don't get full self-driving on the desk of the president and ultimately are able to move the dial on making it more of a federal case rather than a state by state, because, oh yeah, they continue to talk about every earnings call that is really only 2 states that are doing pilot programs with full self-driving and working with Tesla on that right now. And so as we were speaking with Wedbush's Dan Ives last week, he too was reminding that that's where we could see more of this relationship between Musk and Trump prioritize what full self-driving looks like on a grander scale from a federal level versus just state-by-state basis. Yeah,
and also just offsetting some of the concerning potential rollback here of EV era policies and ultimately what that means on a larger landscape. Many have made the argument that Tesla is actually going to be okay. All right, President Trump's newly created Department of Government Efficiency, or DOGE, is seeking employees. Elon Musk-led department posted a job site to X over the weekend under the URL join.doge.gov. This comes as questions continue to swirl around exactly what DOGE is looking to accomplish and Musk's role. Here to tell us more is Yahoo Finance's Washington correspondent, Ben Werschel. Ben.
Hey guys, yeah, so this is just the latest hiring outreach from Elon Musk and Doge. He first made a call for volunteers in November, then salaried employees in December, and now I guess he can use a .gov account to go further. As you mentioned, they're looking for new employees on a variety of fronts: software engineers, info security engineers, financial analysts, HR. And the sort of larger question here is exactly what these new hires are doing. Trump's executive order on Doge, which formalized it last week, kind of described it in more limited terms as kind of modernizing federal technology. And that comes even as Musk, even through the weekend and even through this morning, keeps kind of weighing in on every topic under the sun. So exactly what he's trying to accomplish with this is still unclear, whether it's a kind of government computers focus or broadly, like he initially talked about cutting $2 trillion from the budget. You know, as I mentioned, Musk keeps kind of weighing in on all fronts. And one thing I'm looking at this week is kind of making enemies with all sorts of corners of MAGA world. I keep a list of all the different groups he's fought with, from Trump hardliners to his tech rivals, not just the ones involved in Stargate last week, to maybe even Chief of Staff Susie Wiles. There's reports that he might have limited his access to the Oval Office. So there's a lot going on with Musk, as these sort of new employees, I guess, they put in their resumes.
There certainly is. All right, Ben, thanks so much for breaking that down for us.
Thanks, guys.
Well, that does it for Morning Brief, but keep it right here on Yahoo Finance. Catalyst getting underway next year. Looking at a massive sell-off here across the board, at least for the Nasdaq, off just about 2.8% off the lows of the morning. We'll be right back. Welcome to Catalyst. I'm Shauna Smith alongside Alexandra Canal. We're just about 30 minutes into the U.S. trading day. Let's get you the three catalysts that we're watching this hour.
First up, full market coverage ahead as tech stocks plunge amid China's AI advances. We break down the outlook for the market as investors flock to havens.
Plus, we'll dig into the president's plans for sweeping tariffs and who stands to be most impacted by increasing trade tensions.
And we look ahead to the outlook for the Federal Reserve as investors expect the central bank to hold rates steady for the first time since initiating its rate cutting cycle. The Nasdaq is plunging, leading U.S. stocks lower as Chinese-based AI company DeepSeek sends shockwaves across the U.S. tech sector. We have Barry Bannister, the chief equity strategist over at Stifel. So Barry, we have this huge tech sell-off today driven by these AI fears. We're heading into the thick of earnings season. So how do you think this changes the calculus for this earnings season, especially when we think of things like CapEx spend and margins for a lot of these hyperscalers and chip giants?
Well, to an extent, capital spending creates earnings, right? So if one company spends money, it's earnings to the other company, and that's what's happened with semiconductors. So the other thing to consider is that I know bottom-up analyst, I was one for almost 25 years. Bottom-up analysts focus on earnings. They don't focus on the market and the macro factors. But about 15 years ago, I switched over to this new role, and I'm entirely focused on the macro now. And so when I look at interest rates and treasury yields and Fed policy, it's making those price earnings multiples accorded to those earnings very speculative.
So Barry, does that tell us that maybe we've seen a top?
Yeah, I think the S&P 500 topped there in the low 6,000, 6,100 or so. It pulls back to about 5,500 by the end of the year, and it'll be volatile in the first quarter on the way down. Our bigger concern in the second half of the year is the economy. You know, if we have no landing, then yields have to go up. You get what's called a bear steepener in the yield curve, where short rates are held high and long rates rise. The other option is if you don't have the no landing scenario, it increasingly looks to us like a slowdown in the back half. Economic slowdowns, mid to late cycle slowdowns. We had 3 between 2008 and 2020. They're very normal, and that would lead to a 10% correction of the S&P down to that 5,500 level.
You mentioned yields, and I want to pick up on that point because we're seeing this flight to safety this morning. Yields were down as much as 12 basis points. We're now trading slightly above 4.5%, but still the lowest level in over a month. Does this signal the return of this inverse correlation between stocks and yields, which we haven't seen for quite a minute here?
Well, so much of that inverse correlation that we had seen was you know, when we had the positive correlation, I should say, it was due to deflation fears in terms of prices and of bonds and stocks. But what I'm not really fearful of deflation. What I'm thinking is that the for instance, the MOVE index, the Merrill Lynch Volatility Index for the bond market. If you look at a 200-day moving average of that index, the MOVE index, and compare it to a 200-day moving average of the 10-year Treasury yield. It's much more typical in the last 35 plus years for the move to peak before, not after, but before there is a peak in yields. I don't think we've seen the peak in yields, and in a no landing scenario, a 5% handle on the Treasury would send this market down.
But Barry, I guess the question though is the markets have very much looked past the surge that we have seen in yields. So what is going to make it different that time around or the next time?
Well, we looked at, you know, valuation is interesting because one, it only really tells you about long-term return potential, and two, it only really matters at extremes. So extreme lows like 2009, you were able to pick up the stock market for 10, 11 times earnings. It was just a bargain at the financial crisis low. Similarly, we looked at the long-term trend of PE on 10-year average inflation-adjusted operating earnings, or its proxy equivalent for operating earnings. This is a Shiller-Cape ratio, except we use a proxy for operating, not GAAP earnings. The bottom line is that this was the fifth mania, or bubble, if you will, In the last 150 years, stocks are simply extraordinarily expensive, and cash-laden post-COVID investors simply ignored the risk of paying too much. And as we all know from any real estate or other things we bought, paying too much is not a good thing.
So you mentioned valuation, stocks incredibly expensive. So what we're seeing at the Nasdaq, S&P, is this a necessary correction? And how do you view that playing out through the rest of this year?
Well, yes, it's necessary in the sense that it's breaking some of the market psychology. For example, the AI companies were committing the mistake that AI always, or any other tech company or any other company makes, and that is they were taking very high monopolistic cash flows and redeploying it into a more competitive, low return business. There just seems to be no end to M&A among corporate finance planning people at corporations, but it's a bad move. And with the China model on the AI, probably useful for 90% of AI applications, we are going to see a competitive market for AI. So there was too much exuberance, and that exuberance is being let out of the market. So yeah, it is healthy.
Barry, when we talk about the shift, maybe that is going on. If we have seen a top, if we do see some more selling pressure across the board, where does that leave that value versus growth trade? And could we maybe see some investment opportunity within value?
Our bigger concern as we look at the back half of the year is an economic slowing. Wages respond with a great lag to policy. And so wages are decelerating at the same time inflation is proving very sticky, which has been our view for quite a while. And now it's a little more consensus. So with sticky inflation and declining wages, what happens is your buying power as a consumer after inflation starts to go down. Add to that the volatility I expect of the first year of the Trump administration. They're in a great hurry before the midterms. They've got to do everything in the first 2 years. That's going to cause a slowdown in GDP in the back half and contribute to a more than 10% correction in the S&P 500. So I do think we'll finish this year around 5,500 in a healthy correction, and then we'll have to start looking at 2026.
All right, and we will talk to you maybe about what that holds soon. Barry Bannister, always great to get your insight. Thanks so much.
Thank you.
The release of Chinese-backed AI chatbot DeepSeek is sparking some concerns about U.S. AI dominance and big tech's capex spending. The model is open source, seemingly performs as well as other popular chatbots, and for a fraction of the cost. Now, DeepSeek's founder started the company just back in 2023, which is $1.4 million in capital. Well, meanwhile, the U.S. announcing a $500 billion AI project, Stargate, and Mark Zuckerberg saying that Meta is going to spend up to $65 billion this year alone on AI investments. For more on what this ultimately means for the AI landscape, we want to bring in Sarah Krebs, the director of Cornell's Tech Policy Institute. Sarah, it's great to talk to you here. So I'm curious, how are you looking at the developments and the headlines that certainly were front and center over the weekend, and whether or not this does, in fact, put into question AI's big cap or large cap tech dominance when it comes to AI spending?
I mean, the story over the weekend about DeepSeek really was juxtaposed against last week's big announcements about how much Meta was going to invest in AI and Stargate up to 500 billion. And so it was so interesting to follow that at 5% or a fraction of what these big tech companies are spending, it looks like this small Chinese startup is able to perform in many of the same ways as these American pioneers. I mean, it's an apples to oranges. I don't think it's a one-to-one. It depends on the use case. It seems like it's really good at some tasks, not as good as others. But it is easy to follow. The U.S. Big tech firms have really led in this space, and that takes a lot of capital. It takes a lot of resources. Easier to come along later and try to replicate this at a fraction of the cost.
Sarah, you mentioned that $500 billion Stargate project. How much more pressure does this put on Stargate to really deliver on its promises?
I think it puts enormous pressure on the U.S. AI firms to show that the amount that they're spending is delivering value for people. And I think in that sense, actually, competition, I think like your last guest was saying, probably is going to be a good thing for these companies. It will raise the bar for what consumers and businesses are expecting to get for free, first of all, and in turn, what companies like AI can charge. So I think there will be some really big ripple effects, both politically and financially, even if this alternative isn't a one-for-one.
So could it end up being a long-term benefit not only for others across sectors, but even for those within the industry?
I think that's right. In the short term, obviously, there are, I think, adverse effects because it will kind of raise this question of, well, what's the value proposition for your $65 billion investment if we can get, a pretty decent product for a fraction of the price. But I think we've seen this in other markets as well, whether it's the auto industry. German manufacturers are having a real problem because the Chinese alternatives are pretty good. They're not like buying a Porsche, but not everyone needs a Porsche. Or in the drone market, the Chinese civilian drones are something like 70% of the civilian market. They're not as good as the American versions. So I think what we'll just see is kind of a bifurcation within the market, and not every company can afford, OpenAI's service. They might prefer these alternatives that are a fraction of the price.
And how skeptical are you that DeepSeek is being honest and transparent about the amount of computing it's actually able to use and really all the benefits? How do we know that they're being honest?
No, I don't think we ever know. I don't think it's possible to know at all. And looking at some of this hype over the weekend, it almost looks like they've deployed some engineers to talk up the performance. It does look like a pretty good product, but we have no way of knowing how much was invested in this. But I do think that we can probably ballpark and say that what we do know is that they're not using these super expensive Nvidia chips that we banned their access to, and they are able to do a pretty good job without access to those chips and without spending nearly as much, even whether it's 5%, 10%, 30% as much, they're still doing pretty well at a fraction of the cost.
Sarah, is it at least as good as the US models?
I think it really depends on the use case. It looks to me like what is really good at discrete niche tasks, whether it's math problems. A lot of what I was reading over the weekend is it's really good at math problems, but probably less good at the range of activities or use cases that people who are using and spending money on ChatGPT would want to see.
Sarah, how do you think this changes the administration's view on TikTok, if at all?
Well, it does raise a really interesting question. So the administration has come in, obviously, and been more willing to be permissive and think about a deal with the Chinese, with ByteDance and a divestiture. In some ways, I think that this recent news about the Chinese DeepSeek validates that, which suggests that this technology, whether it's AI or social media, you cannot put that genie back in the bottle. It's out there. And trying to ban TikTok, for example, maybe you can do it, but then this next thing is going to come along and all of the information. I mean, now this DeepSeek is #1 in the App Store for free apps. So now all these Americans are putting new data, new interest into this chatbot. And that's a new concern. So I don't see how it's possible really to stay on top of this. And it does look like, in a way, trying to embrace rather than play whack-a-mole might be the way to go.
Sarah, real quick, what did the regulatory aspect of this conversation look like? Is that sparking almost a new conversation or renewing that conversation?
Well, I think it raises this question on a lot of fronts. The U.S. has had a very tight regulatory environment with respect to exporting advanced AI chips. And it raises the question of whether that has really done anything. Obviously, it has limited the ability of the Chinese to access the most advanced chips, but it raises questions as to how effective those policies are, these kind of policies trying to restrict access, whether it's social media or chips, are really doing much, if at all, in stifling Chinese growth and tech advancement.
All right, Sarah Krebs, thanks so much for taking the time to join us here this morning.
Thank you.
As we head to break, we want to take a look at new home sales data. It's crossing the wire right now. This is for the month of December. New home sales coming in at 698,000. That was above the street's consensus. Now, the data showing that sales of new U.S. homes ended 2024 on an upbeat note in December as customers took advantage of incentives from builders, leading to a second straight year of increased purchases. Now, when you take a look at the reaction, not much of a reaction that we're seeing in the market here this morning. But again, when you take a look at that percentage number, what this ultimately means, you got December new home sales rising 3.6%, rising a total of 24,000 in December from the prior month for new home sales there. Again, ending the month on a positive note. We've got much more coming up on Catalysts. Now, time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of this session with Yahoo Finance's trending tickers page. First up, let's take a look at Universal Music Group and Spotify reaching a new multi-year deal for recorded music and publishing rights, establishing a direct license between the streaming company and the world's largest music label. You're looking at UMG. Define that sell-off that we're seeing more broadly play out on the street. Shares up just about 6%. On the flip side, you got Spotify off nearly 3% here. But Ali, I know that you've been going through quick analyst reaction here this morning, and it looks like many are almost characterizing this as a win-win here for both sides.
Yeah, Wall Street very bullish on on this agreement, especially because it came earlier than expected. The last renewal was July 2023. So analysts saying that this early announcement is a good thing. Spotify would not enter any type of deal if it wasn't going to be positive for that company in the long run. Now, digging into the terms, the two companies said that they will closely collaborate to advance the next era of streaming innovation. They're calling it Streaming 2.0. This will include new offers, paid subscription tiers, bundling of music and non-music content, and a richer audio and visual content catalog. JP Morgan saying that Spotify is, again, like you said, a win-win for this deal. Morgan Stanley said the deal represents a positive catalyst for UMG and a, quote, broader affirmation of the music industry's alignment to improve monetization through the value chain. Now, one thing that stood out to me is that the publishing agreement is the first that Spotify has struck with UMG. Now, publishing, that basically encompasses everything outside of the recording, so the melodies, the lyrics, that's important, and it's going to establish a direct license between Spotify and UMG, which is one of the largest record labels at the in the world, I should say. So again, we're seeing shares up about 6%. We know Spotify has been maintaining its outlook, really wants strong margins. It's unclear right now what that will mean for the economics moving forward. But
yeah, I was going to say, and is that maybe indicative, and it's hard on a day like today to really dive into a deal like this, but is that maybe indicative as to why we're seeing the stock under a bit of pressure today, just in terms of what this ultimately means spending-wise?
Look, it took Spotify a long time to get to where they are now. They're seeing, successful profitability, lasting profitability. I don't think they would enter into anything that was going to jeopardize that, especially as we've seen this intense run-up in shares over the last 2 years. But that is something that analysts did note, that they're unsure what the economics are going to mean. So something to look out for on the earnings call coming up. Another trending ticker we're watching today, U.S. Steel. Activist investor Ancora Holdings pushing U.S. Steel to drop its failed merger plans with Nippon Steel. That would mean dropping litigation to salvage the merger after it was blocked by the Biden administration earlier this month on national security concerns. Ancora also pushing for 9 new board members and a new CEO. Now, it's unclear how big of a stake Ancora has acquired. It is pushing the company to abandon the takeover plan overall. Like we mentioned, replace current CEO David Burritt with former Stelco Holdings CEO Alan Kestenbaum. And largely this stems from Ancora believing that it can make U.S. Steel profitable without any type of deal. So even outside of Nippon, not interested in selling the steelmaker to another party. Now, remember that Biden, he did block this deal. He opposed this deal. Trump has also said that he would oppose this deal. Not a surprise there, considering his protectionist policies. I don't think would like that this key U.S. asset could potentially be under foreign control. So multiple roadblocks here.
There are a couple of roadblocks here. I think my biggest takeaway is that the fact that they're really pushing for U.S. Steel to go about this alone, pushing for a turnaround here instead of a potential sale, and ultimately what that is going to mean here for the company going forward. U.S. Steel was very quick to respond, pushing back on this, saying that Ancora's interests are not aligned with U.S. Steel stockholders. They also went on to say that stockholders are not going to be well served by turning over control of the company to Ancora. Quote, "We are also concerned about the motivations behind these nominations, given Ancora and Alan Kestenbaum's recent dealings with failed bidder Cleveland Cliffs." So again, a couple of pushback notes there from U.S. Steel. Not exactly a huge surprise, but you're looking at shares under a bit of pressure here this morning. Well, finally, let's take a look at big tech. The big story of the day, it's lower amid China's AI model DeepSeek. It's sparking some fears of ultimately what this means for the AI investment landscape. It certainly is sparking a massive sell-off. You can take a look at some of the big names on your screen here this morning. You're looking at Alphabet off about 3%, Microsoft off about 3.5%. Amazon is also in the red this morning. Microsoft CEO Satya Nadella over the weekend writing, quote, that Jevons paradox strikes again as AI gets more efficient and accessible. We will see its use skyrocket, turning it into a commodity we just can't get enough of. And Ali, the reason why we are highlighting some of these reactions here from some of the largest big tech CEOs is the fact that they do seem very positive about the developments, just in terms of ultimately what this is going to do for wider scale adoption and how big of a game changer this could ultimately be here for the AI investment story down the line.
Very opposite for what we're seeing in the stock market today. Businessman and software engineer Mark Andreessen, he also had a series of bullish tweets. He said, DeepSeek R1 is AI's Sputnik moment. Sputnik was the first artificial Earth satellite launched by the Soviet Union in 1957. recession. He then followed that up with a second tweet saying that it's the most amazing and impressive breakthrough I've ever seen and has open source a profound gift to the world. Now, Salesforce CEO Mark Benioff also weighed in on this. He said that DeepSeek is now #1 on the App Store, surpassing ChatGPT. The real treasure of AI is not in the user interface, it's in the data. He categorized data as the new gold. So a lot of rhetoric here as AI and data as commodities, which I thought was very interesting.
Yeah, certainly. And I think the big question here for investors going forward, and you and I have talked to so many guests here so far this morning, is just one, how real of a threat this is, what the capabilities are, whether or not it's as good as, whether or not there's potential for it to be even better. Much of that being refuted at this point, just in terms of comparing these models, stacking them up against one another. But also the big takeaway here, what we can see from the street, is cost and how that is factored in. And I think we're going to be getting a little bit more commentary, hopefully a lot more commentary from some of these larger cap tech CEOs over the next several days when we get into earnings season. But again, just in terms of CapEx spending plans, how that is planning to play out here over the next several quarters, and whether or not DeepSeek puts some of that into question.
Yeah, and that's exactly what Sarah Krebs from Cornell said. We just spoke with her. She said it's really hard to tell whether or not they're being honest, whether they're being transparent. But to your point, the one thing that we do know is that it's less expensive. Yeah. And it is interesting looking back at previous earnings seasons, because when companies weren't spending as aggressively, investors didn't like that. They wanted them to spend aggressively. So now we're seeing this flip effect that I wonder how that's going to really trickle through into some of the stock reactions.
Yeah, certainly. And you can even just see the reaction in Meta shares on Friday when we got that update from Zuckerberg spending up to $65 billion. At first, we saw a little bit of concern, then the market quickly brushed that off. And now we're seeing obviously that front and center here this morning. So any updates there, the fact that maybe this could potentially be gearing up to be an even more challenging earnings season for larger tech than maybe any had initially anticipated.
Yeah, those calls are definitely going to be all the rage this earnings season. But all of your markets actions straight ahead. Stay tuned. You're watching Catalysts.
In a whirlwind few hours over the weekend, President Trump threatened, then he held off on 25% tariffs on Colombia, holding off after reaching an agreement over deported migrants. Still in play, though, are sweeping tariffs on Canada, China, and Mexico, which could go into effect as soon as this weekend. So what are the implications of those proposed tariffs? Let's bring in Brad Smith. He's standing by at the touch, here to explain it all. Brad.
Yeah, thanks so much, Shauna. Let's start simple. Tariffs are taxes imposed by one country on goods imported from others. In the simplest terms, they're used to collect income, reduce competition for domestically made products, and place an economic burden on foreign exporters. For that reason, they're often used as bargaining chips. Former President Biden actually used a few selective tariffs during his presidency against China to support American manufacturing of semiconductors and solar panels. But the key word there is selective. Only on certain products. The tariffs President Trump is calling for are sweeping, and the implications are much broader. Mexico, China, and Canada are the U.S.'s largest trading partners. If the proposed tariffs are implemented, a slew of goods like cars and electronics, they could get more expensive. And so could raw materials. So when the costs go up for aluminum, oil, and steel, even if something is made in the U.S., manufacturers will pass the cost on to American buyers. In tandem, oil prices also could spike higher. Canada is one of America's and is America's largest source of petroleum and crude oil, supplying about 52% of the U.S.'s total imports in 2022, according to the EIA. Could the U.S. get their goods elsewhere? Eventually, maybe. But building factories and reorganizing global supply chains, yeah, that takes time. In the meantime, though, Americans may end up paying much more for everyday things. Shauna and Allie?
Brad, thanks so much. Well, President Trump was victorious in his showdown with Colombia over the weekend after he threatened the country with tariffs and visa restrictions if they did not accept flights of deported migrants. Tariffs have been the topic of conversation under the new administration, with Trump saying his proposed tariffs on China, Canada, and Mexico could come as soon as February 1st. Here to discuss is Christine McDaniel, Mercatus Center Senior Research Fellow. And Christine, I want to start with what happened between the U.S. and Colombia. It seemed like the threat of tariffs worked for President Trump in this case. Given that, do you view tariffs as more of a negotiating tactic, or do you believe the president when he says he's going to be aggressive when it comes to certain nations?
Well, I'm an economist, so, just like Brad was saying, I mean, yes, a tariff is an import tax. It raises prices. But President Trump has been able to use tariffs as a very effective negotiating tool so far, in the less than a week he's been in office. But it's been quite remarkable. And look, I mean, President Trump campaigned on certain things, border control, border security, fentanyl crisis, and getting other countries to increase their defense spending. He seems to be very serious about that, and he sees tariffs as a tool to use to achieve those goals. So, we saw that even before he got in office, he was tweeting about, to Mexico and Canada about the tariffs. And then before you know it, Canada's Trudeau comes down, has dinner with him and his border czar at Mar-a-Lago, and goes home with an announcement they're spending more on border security and defense. And Mexico's Sheinbaum announces that they will be putting a lot more resources into processing illegal migrants at the border before they go to the U.S. So he's, it's pretty remarkable. And so far, it has worked there, and it has, just as we've seen over the weekend, now worked for Colombia.
Is it going to work, though, with China? I think that's a big question.
That's a big question. China's, not Colombia. But did you see Trump's talk at Davos? Watch the whole thing. It's really interesting. When he was asked about China, the first thing he said was, he called me. And he sees his relationship with Xi as very important, and also, I think, very positive. So the fact that Xi and President Trump are already talking very closely, Vice President Vance met with his counterpart also recently. It seems like they perhaps have some understanding about what each other's priorities are and where the red lines are. I'm cautiously optimistic.
How are you viewing the cost benefit when it comes to tariffs on certain countries? In other words, is there more of a downside risk when you slap a tariff on Mexico, China, one of the U.S.'s largest trading partners, versus putting tariffs on China?
No, yeah, absolutely. I mean, look, I mean, if these tariffs come into effect, then yes, there will be economic effects. I mean, the U.S. Importers, U.S. businesses will absorb some of it. They'll pass some of it on to U.S. consumers, and then also foreign exporters. They may also absorb some of it. What we're hearing from some retailers, especially in footwear and apparel, textile industries, is they were able to absorb a lot of the tariffs in the first round. They won't be able to absorb much more moving forward, which would suggest that U.S. consumers would bear more of the burden. So, I don't think it's going to sink the U.S. economy, but it definitely is going to make Trump's goal of fighting inflation that much harder.
Christine, what do you see the impact on the global economy? And I bring that up in the context of, if you just take a look at tariffs on Canada specifically, Torsten Slok sent out a great chart, I thought, this morning. He was actually pulling it from the Bank of Canada, and they ran this simulation of the impact here on Canada if the U.S. were to impose 25 tariffs. And very much you can see that downside risk outweighing any sort of upside risk. But it's true not only for Canada, but also when you take a look at the world's impact. So how should investors or economists here, how are you thinking about that real world impact?
No, for sure. I mean, we ran the simulations as well, and there's a huge global downside risk, and the U.S. Will bear the majority of the burden of that. But yeah, I think, I mean, look, if the tariffs do come into fruition, that's one thing. And then it's another thing if countries retaliate. Retaliation increases the cost immensely for the world. And, it's hard for countries not to retaliate. No, I mean, this could definitely shave a little bit off of global GDP growth, especially for the larger countries. It really just depends on, to what extent other countries are willing to cooperate with Trump and his team on their key goals. But if the tariffs come to fruition, and if other countries retaliate, then consumer prices will go up. Global growth will take a bit of a haircut, and we'll be looking at not as happy days as we would have been. So we're really hoping that other countries will cooperate with Trump and his team on these key goals that he campaigned on.
And to that point, you just said consumer prices going up. A big question has been who pays for tariffs. Trump says he believes that tariffs are paid by other countries. You say the data, that doesn't really show up. So who pays here?
Yeah, well, I mean, if of course, the United States pays. They pay. How much they pay depends on the market situation, right? So the tariff is usually shared between the foreign country and the U.S., right? And then who in the U.S. pays? Is it the U.S. businesses, the importers? Where along the supply chain? Is it you at the checkout aisle? It's a little bit of all of those entities, of all of those market participants. We saw that in the 2018 tariffs. All studies have shown that U.S. consumers paid for at least some of the tariffs. That's just not even, that's just obvious to everybody who looks at the data. But it didn't sink the economy. So, So I don't know. I don't take everything he says literally, but I do take, his goals, he takes them very seriously, and so should everybody. And again, that's why I'm really hoping that other countries will cooperate with his team on these key goals so we can avoid a very costly global trade war.
Christine, real quick, just we only have about 15 seconds here, but how likely is it that we actually are going to see these tariffs implemented on Saturday?
Well, for Mexico and Canada, it sounds like there's some people in the administration that want to go ahead and do it, even if the goal is to take them off if they can get a deal. So I'd say maybe 50-50, depends on what parts of the Trump team wins out in these key talks behind the scenes.
So it can go either way. All right, Christine, great stuff. Thanks so much for joining us.
Thank you.
Coming up, the potential impact of AI, what it could mean for economic growth in the years ahead. We've got that coming up next on Catalyst. Federal Reserve is expected to hold rates steady at its meeting this week. According to CME FedWatch, the probability of the target rate staying at its current level is just around 97%. We want to bring in Paul Grunwald. He's S&P Global Ratings Global Chief Economist. Paul, it's great to have you here on set with us. So talk to us. You were just in Davos.
Correct.
And we heard from President Trump. He beamed in over at Davos. He was talking a lot about just the state of the macro economy right now, where things stand. I'm curious just from a Fed's perspective. Obviously, President Trump has been very vocal on what he wants to see done at the Fed. What are you expecting to hear from Powell and their assessment right now?
Right. Well, we think they're going to be on hold in January. The U.S. economy, contrary to some of the political discourse, is still running a bit hot. And the Fed is trying to land the economy. Services inflation is still sticky. Some of the data from late last year is actually coming in a bit stronger than we thought. Some of the retail for December, the nowcast from the Atlanta Fed is looking close to 3%. So I think the FOMC is going to be pretty comfortable with a hold in January.
Now, I've seen a lot of chatter from economists that it's probably going to be a pretty boring meeting with the holds, not much to look for from the policy statement. Are you viewing any type of surprises, or what do you want to get from this meeting?
Yeah, well, I think people are starting to question which direction the next move's going to be in, right? Because we still have sticky inflation, growth still a bit too high. We've got a new administration that wants to juice things up a bit. So, we were thinking before that the Fed was going to go one or two more this year. That's our base case. But if we, get some stimulus into the economy and things start to pick up from the policy side, then, the next one may not be down. That's not our baseline yet, but that's just kind of emerging into view.
Is that becoming a higher likelihood?
Yeah, I mean, it's not the baseline, but it's, if you just listen to where the current administration wants to go growth-wise, and they're not talking about landing, they're talking about stimulating the economy. So I think that's now got to be part of the conversation.
And we mentioned that you were just in Davos.
Yeah.
I'm curious what the topic of conversation was in Davos and how you can apply that to what we're seeing today when there's a lot of fears over AI, the dominance of the U.S. What takeaways?
Well, dominance of the U.S. was a given. I think it was a very consistent theme that the U.S. continues to outperform the rest of the world. That was one. There was the official program, which was dominated by a lot of AI this year, right? Every possible angle, and I think it's going to be, sort of a decadal, slog through the economy with everyone looking at things, maybe some productivity gains, maybe a growth dividend down the line. But the thing that was off the agenda that everyone was talking about was obviously Trump 2.0. One of my takeaways talking with people in Davos was they kind of know Trump's business model, so they've built in some redundancy into their businesses. Maybe they're holding more inventory, maybe they're diversifying their supply lines. So they see it now as a cost of doing business almost for the US. As an economist, you kind of call that a deadweight loss, but I think they're less stressed out, and it's kind of a known unknown now what's coming. So there seem to be they're pretty sanguine and resigned that it's just going to be a little bit more expensive to do business with the U.S. in the next 4 years.
But it also sounds like that U.S. exceptionalism narrative is very much maybe still intact.
That's very much intact, and the dumping on Europe was also intact too. I mean, the Europeans are trying to get to a point where they can finance and scale some of their own innovation, because right now they're effectively outsourcing it to us here in the U.S. So they want to sort of bring that on shore, which is interesting.
Well, is there a risk, though, if the Fed is too late to act here? And we do see the Fed go on hold not only at this meeting, but at potentially the next meeting as well, being a little bit behind just in terms of the ramification that could have 6 to 12, 18 months from now.
Oh, you mean on the upside,
yes.
If we get a pickup? Always a possibility, but again, financial conditions are pretty tight. We'd have to see a real juicing up of growth. A lot of the AI you mentioned before, that's going to come in very slowly because all the industries are working through that. I would put that as sort of a medium-term tailwind to growth, but probably the next 2 years, maybe not so much.
You mentioned productivity, and that could feed through into GDP. AI, obviously a big part of the productivity story. We had that Stargate announcement that was made, $500 billion, the promise of 100,000 jobs. Do you think Stargate can deliver on that?
Yeah, I'm not going to comment on this particular company, but the technology, people are looking at it everywhere. We're looking at supply chains. They're looking at manufacturing. They're looking at medical. They're looking at education. It seems to be improving everything everywhere. So again, people make the analogy with electricity, right? It took a couple of decades for electricity to get in to the economy. New stuff like, production lines and assembly lines were kind of invented on the back of that. So again, it's going to be an uplift. Where and when exactly it comes is a little bit open question, but certainly
lot of optimism, a lot of feeling that this is going to be a tailwind for many years to come, which makes life everywhere a lot easier. You get a big productivity boost, right?
Well, then, Paul, when you see that today's developments and headlines are really over the weekend when it comes to DeepSeek,
yeah, that was interesting.
That then speeds up that timeline, right? Or guess, or like how are you?
Right. I mean, there's sort
that?
of some friendly competition there between the U.S. and the Chinese. The Chinese did this without the advanced chips, so it's going to be, and maybe it's a little less capable than the stuff on the U.S. side. But this kind of notion we're going to have this, new technology that can create things and help us optimize and higher productivity and everything. That's going to be a boost to everyone. But part of the race around AI has got some U.S.-Chinese competition elements to it as well.
Certainly do. All right, Paul, always great to have you.
Good to see you guys.
Much.
Yeah, thank you.
Well, coming up, we are exploring some crypto options trades investors can consider in 2025. We've got that for you next.
Bitcoin currently back above the $100,000 mark, pulling back a week after the cryptocurrency reached a new all-time high above $109,000 a token. Our next guest has a few option strategies for crypto. Luke Stryers, Deribit CEO, joins us now for an option segment sponsored by Taste You Trade. So Luke, what should investors consider when they're playing options on Bitcoin and other types of cryptos?
A lot. First of all, thanks for having me. The stuff they need to consider is that Bitcoin is even more volatile than AI stocks or stocks like Tesla or S&P options. So it's a volatile product, so you need to be careful and watch out and be willing to accept the losses that could be triggered. So that's the first thing. We've seen that today, market crashing, Bitcoin dropping below 100, reached 98K and recovering already. So it can be volatile. And in order to benefit from that, you can do a few things. If you're bullish on Bitcoin and you believe in the Trump narrative that markets will rally, institutional investors will come, Bitcoin price will most likely reach higher levels versus today. So what we see people doing today, and that's based on actual data, so the last weeks, there's plenty of call spreads being bought. That means that clients buy a call option, so let's say 110,000 strike, and they sell a further out of the money option, for example, the 150K. If the longer duration you take, the further out, the more expensive it gets. But let's say you pick March or June, so 3 to 6 months from now, the benefits could be sizable if what happens is in line with what you expect. So if you just buy a call option, you buy premium, you long premium, which comes at a price. If you sell an option, a further out of the money option, the actual benefits is that you reduce the overall strategy cost. So the option you sell is actually income. So instead of paying, let's say, $8,000, you pay $6,000. So you reduce the overall cost, and only hitting a cap when the higher strike is reached. So let's say you sell the 150K, that means that if Bitcoin reaches 110K or more, you actually make money. So in this case, approximately $40,000 minus the cost. So let's say $6,000 approximately. That means that let's say you round it, you make around $35,000. Deribit is a crypto venue, so Deribit only accepts crypto collateral. That means that for this trade, you actually have to deposit crypto. So also, when you deposit Bitcoin collateral for this trade, the collateral will go up as well, which gives an extra kicker. So that's something we see a lot. Of course, different expiries, different strikes, and every investor has different flavors, but that's one of the more higher volume products at this moment.
Well, Luke, just given the uncertainty and the volatility surrounding crypto, I think that's front and center when you talk about crypto and you talk about options, right? What is that number one thing that investors need to keep in mind given that higher risk that they're now facing?
The volatility can be high. So today there was just minor news, essentially big news for the overall market, but minor news for crypto. But crypto still responded. So the move was from 105K to 98K. If there's crypto news, it can go much faster. If there's regulatory changes in the landscape, if there's opportunities like strategic reserves, etc., it can go very fast in a bullish direction. But if there's problems, we've seen it in the past with exchange problems or other large players that run into issues, the market can correct downwards rapidly as well. So the volatility of this asset in vol points measured, what we call devol, is a bit like VIX, but then for crypto. It's looking at 55, 60 at the moment, which is, let's say, 2-3 times as high as US stocks, pending the risk of those stocks, but it's very high. So it can go in your direction or it can go in the wrong direction, and you need to be willing to face the consequences.
All right, Luke Stryer, CEO of Deribit, thanks so much. Let's do a quick check of the markets amid today's sell-off. You're looking at the Nasdaq off just around 2.5%, the S&P off about 1.5% off the lows of the session. The Dow just below the flat line here as the market reacts to DeepSeek, the Chinese AI intelligence, and ultimately what that means here for the AI landscape going forward here. You're seeing a sell-off across as many of those larger cap tech names, really leading the decline beyond some of those Mag 7 names. You're also seeing selling in some of those chip stocks in the energy space, areas that have really gotten a boost here over the last several months in association with the AI trade. A bit of an unraveling of that here this morning. Again, though it is important to point out we are off the lows of the session. Coming up next is Wealth, dedicated to all of your personal finance needs. Brad Smith has you for the next hour. We'll see you tomorrow.
It's time for Yahoo Finance's Market Minute. The Nasdaq is leading the major averages lower as China's DeepSeek sparks AI competition fears. Large cap tech having its worst day since September. The news rippling across sectors. Chip stocks are under pressure, with Nvidia and Broadcom some of the biggest losers of the day as investors grapple with DeepSeek's ability to forego the most advanced AI chips. And nuclear energy stocks plummeting. Constellation, Vistra, and Oklo all down double digits as investors consider the massive investments in energy that AI hyperscalers are making. Plus, SoFi falling as weaker than expected guidance for its first quarter, overshadowing a strong earnings beat. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. Hey, on today's show, we're going to talk about today's AI tech-led sell-off, and a portfolio manager will hit home on the importance of diversification in your portfolio, particularly on a day like this. And the 2025 tax season is officially underway. We'll be joined by H&R Block's VP of the Tax Institute. Also, we'll dig into the top things that you need to know as you're gathering your forms. And a new survey reveals 2 in 5 Americans in a relationship have kept a financial secret from their partner. We'll dig into the results and talk about how you can avoid financial infidelity. Yeah. All right, all that and much more coming up. But first, let's take a look at some of the market action. 90 minutes into the trading day, stocks falling as today's China AI model DeepSeek is really sparking a sell-off here. Joining me now, we've got Justin Haywood, who is the Haywood Wealth Management President and co-founder. Justin, good to have you back on. You say diversification is critical for investors. So how should investors be looking to diversify?
Yeah, absolutely. Thanks for having me on. Obviously, depending on where you are in your retirement journey, you'll want to have a portfolio that's aligned with your personal risk tolerance. So today, obviously, just sort of amplifies that need. Bonds are a great place to be. The 10 years yielding 4.5%. Another thing that people have been beating the drum on for a while is the equal weight S&P, and today is a big win for that equal weight S&P when you see the top end of the S&P down so heavily. So you just want to remain diversified, have exposure to many different asset classes and sectors, and that way on a day like today, you're not going to take as hard of a hit. Now, you may not see the same upside over the long run, whenever the market is roaring like it has been, but on days like today, you sure would be happy.
Is there safe risk to assume when you look at a pullback like this and on a day like this, where I get what you're saying, in having that diversification, you have exposure to your safe havens, and then you have exposure to some risk propensity as well. But is there good risk, and how can an investor assess that even on a day like today?
Yeah, sure. I mean, in order to, over the long run, outpace inflation, you're going to have to take on some level of risk. I mean, the only quote unquote risk-free asset is a short-term U.S. Treasury. So even with bonds, if you're getting further down the 10 to 30-year maturities, there's some level of risk there. Now, again, depending on your risk tolerance and what you are comfortable with, that's going to determine just how much risk you want to take. But there has to be some risk in a portfolio. Otherwise, you're just going to be sitting in a checking account forever and not earning much.
Yeah. Justin, of course, we have a ton of big events this week. Earnings, you've also got a Fed decision. Let's stay on the Fed decision for a hot second here. What is your outlook for what we could see announced from the Fed, and ultimately what they could set the tone for the rest of the year as well?
Sure. I mean, I think for this meeting, they're going to hold rates steady. You might have seen last week, Trump was asked about his potential pressuring the Fed to bring rates down, and was asked if he thinks that they would listen to him, and he said he thinks that they will. So with the PCE coming in Friday, what I'm sure the Fed is really hoping for is some softer inflation. That way, if they do get some of that pressure from the president, it will the cuts will at least be, in their view, warranted.
Justin, while we have you here, thinking through some of your top plays right now, what is at the kind of forefront of your mind as you're looking at the markets on a day like today and really charting what the next big investments that you or some of your clients are looking to make are?
Sure. I know today with the DeepSeek news, it's really difficult to keep things in perspective, but I think we are still kind of in the early stages of a secular AI trend. I think there's still a lot of potential in the technology sector. Nvidia is getting crushed today on that news, but you see Meta, I think last I looked, was up a couple of percent today. And there may be some possible beneficiaries, even Amazon being able to tap into some of these open source AI models since they haven't been developing their own. I still think you want to have some weighting to big tech, but again, you'll want to make sure that that's in line with your overall risk tolerance.
Justin, thanks so much as always for taking the time here on the day. Appreciate it.
Thanks, Brad.
It's now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's check in on Ryanair, reporting better than expected third quarter earnings results. Revenue growing nearly 10% from the year prior, coming in above estimates. And traffic, that actually grew 9% despite prolonged Boeing delays, helped by higher ticket prices and strong last-minute holiday bookings. Ryanair is trimming its fiscal 2026 passenger growth target for a second time due to the Boeing delays. The airline is also hopeful that the remaining 29 of 210 Boeing game-changer aircrafts can be delivered before March 2026, which could help make up for some of the delayed traffic growth. Next up, we got to take a look at Take-Two Interactive getting an upgrade to buy from neutral at UBS. The analyst citing a strong lineup of upcoming games, including Grand Theft Auto 6, GTA 6 there. As a result, the analyst expects higher bookings, profits, and free cash flow over the next 2 years here. That could help lower debt and free up capital for investments. The price target bumped up to $230 from $175. And last here, Hilton says it hit a record number of rooms in 2024. The hotel chain added 100,000 rooms last year, single biggest increase ever, resulting in net unit growth of just over 7%. And it signed more than 1,400 hotels, representing over 150,000 rooms in 2024. With that addition, the company is reporting an 8% increase in pipeline rooms. And the company's president and CEO, Chris Nassetta, says that they see development pipeline and construction starts strengthening, and paired with strong travel demand, they have increased confidence in expectations for net unit growth of 6 to 7% in 2025. Another trending ticker that we're tracking today, SoFi, beating analyst expectations for revenue and adjusted earnings per share in the fourth quarter. The CEO, Anthony Noto, calling 2024 SoFi's best year ever, but the stock is under pressure as the company reports weaker than expected first quarter and full year guidance. Here to dive in to the results, we've got Vincent Kantic, who is the managing director at BTIG. Vincent, great to have you here with us today. Just take us into your analysis of these SoFi results and what analysts and investors are probably paying the most attention to, especially considering some of the guidance that was offered.
Right. Thanks for having me. So to your point, stock's down about 8% right now, and that was actually primarily driven off of EPS guidance for 2025. That is about 7% below consensus. And it's interesting because revenue guidance was actually 6% above consensus, but because of the investments and expenses that they're putting in, that EPS guide, that EBITDA margin is below consensus. It's interesting as well because they provided 2026 guidance, and that EPS is actually well above where consensus is at about 67 cents versus consensus of 49 cents. So there is this debate about whether or not the company can execute on that level of growth that's needed to get to that 2026 guidance.
Yeah, you started to answer this, but how difficult does it begin to top what Anthony Noto called best year ever for the company, and where that growth goes from here?
Right. So they've provided guidance where they think they can continue to grow 25% year-over-year CAGR through 2026. So that continues to be really impressive. However, the EBITDA margin guidance for 2025 is about 26%. Versus their long-term guidance of about 30%. So they are essentially investing more to get to that growth. They're putting a lot of expenses in and perhaps pulling forward some expenses that will happen in the future. Now, to your point about Anthony Noto's comments of 2024 being the best year, they announced several wins, including winning the U.S. Department of Treasury's Direct Express program, as well as a financial services company that was going to be a top 10, as well as a hotel as well. So just across the board, all these new programs that are coming in, they are going to take some integration and other sorts of onboarding expenses. So I think that's what you're seeing in 2025 that will then lean into the results, the strong results that they'll see in 2026.
Yeah, some good reminders there just about the entire backdrop and what the business has announced as well here. You know, while we have you here, what do these results say to you about the state of the consumer right now?
Right. So the consumer it's interesting. The lenders are doing a good job with the consumer in the sense that they're tightening up. They're finding attractive, high performing consumers, and for the consumers that maybe wouldn't qualify for their results, there are other lenders that are willing to buy into that. So SoFi is actually taking advantage of that, and they're calling it their lending platform program. Now, the consumer, it's interesting. You'll see some of the companies so far have reported really good results for the consumer, and some of them haven't reported great results. And it's kind of across the board. It's not really differentiated just with subprime or prime or super prime. So it's still mixed trends. I'm still anticipating that spending overall in credit cards is going to be weak. Now, that's off of a 2024 backdrop where spending has been very strong. But, you know, I think consumers are still going to have to work towards paying some of those bills with credit card debts at all-time highs.
You know, as the consumers out there are trying to figure out, you know, to what extent we could see a Trump administration pursue any type of loan forgiveness, which nobody's really holding their breath for that. But if that is the case, what does that pass through for SoFi?
Yeah, it's interesting. Some of these programs would be helpful for SoFi. I know it would be helpful for the consumer generally, right? So that actually improves the credit trends for the consumer, which would allow the consumer to then spend more and to borrow for other things such as auto, such as mortgage, maybe even student lending. If you forgive that, they might go to graduate school. So that's a couple of things that actually SoFi had reiterated, such as their student loan growth program, particularly if the government actually gets out of student lending with Grad Plus as one of those things. So it would be helpful for the consumer. Now, I'm not sure about the U.S. budget if that happens, but it would be helpful for the consumer, and that would spur more growth for these lending and credit card companies.
You know, as you were mentioning credit a moment ago here too, isn't the backdrop of credit right now, some of the payments, the minimum payments, people making minimum payments, jumping to 12-year highs according to the Philadelphia Fed. So for SoFi, how are they navigating a consumer that is clearly needing to lean on credit for more, but paying down some of that debt at a slower pace?
Right. Yeah, that Fed survey data was surprising. And Capital One actually on their earnings call actually pointed that out as well, that they were seeing minimum payments increase. And not just for the subprime consumer, which tends to be, people tend to think about that as a low-end consumer problem, but it's actually even the prime and super prime. But for SoFi, because their technology is able to differentiate between different consumers, is actually they're able to grow into that as well as be very selective. Now, as well, their loan platform program is actually allowing them to be very selective, put some of those loans that qualify to be within SoFi's high quality balance sheet to stay there. But then those loans that they might have otherwise declined, so about 70 to 80% of the applications that SoFi gets, they actually decline. Now, they can actually serve those customers if they find other investors who are willing to go deeper into credit. And they are finding those investors. And we are actually seeing it with some of these multi-million to billion-dollar forward flow agreements that they're signed. So most recently with Prudential's insurance group, previously with Fortress. So they're actually able to serve different companies, and their technology is actually able to differentiate, keep their balance sheet very strong, as well as serve these customers through other investors.
That's interesting. Really good insights, Vincent. Thanks so much for taking the time.
Okay, thank you.
The aerospace and defense sector could be in store for a big year of change under the new Trump administration. Yahoo Finance's Josh Lipton, he's been covering this one and joins me now with a closer look at what investors can expect. Hey, Josh.
That's right, Brad. So if investors are looking to play offense in 2025, should they stick with defense And by that, we mean defense stocks. The iShares U.S. Aerospace and Defense ETF tracks this sector, ticker ITA. Now, it did recently hit a record high. It's up around 30% over the past 12 months. A key question for investors in this space: what will U.S. military spending look like under the new Trump administration? Will there be significant change under Trump 2.0? I recently spoke about that with Citi's Jason Gursky, who covers this sector.
The Republicans in the House over the preceding summer to summer of 2024 put together a special commission that said, hey, we're spending too little on defense. We think it should be closer to 5% of GDP. And that number, interestingly, kind of aligns with what President Trump is suggesting he'd like to see the Europeans spend, which is 5% of GDP. I don't know that we're going to get all the way there in either region of the world, but it does suggest that the propensity of spending is likely to go higher from here. So I think low single digit is like, that is kind of in the bag. And I think we could see upward pressure on that. And then that further upward pressure on the modernization accounts on top of all of that. So pretty good, robust outlook, I think.
Now, a couple other important variables for investors in this sector to consider, like DOGE, our new Department of Government Efficiency headed by Elon Musk. Its objective, remember, make the government more efficient. They want to cut at least $1 trillion per year in federal spending. That is a bold target. Could that include cuts to military spending? Tony Bancroft, a portfolio manager with Gabelli, tells Yahoo Finance he doesn't bet on that actually happening because defense spending, he says, is ultimately driven by Congress. And given the backdrop of geopolitical conflict and uncertainty right now, he doesn't see cuts coming. Another issue: Pete Hegseth was confirmed by the Senate as Secretary of Defense. His supporters say he is a change agent for the Pentagon, and analysts in this space are watching him closely because, after all, he will be the person helping to define the DoD's mission, setting policy and priorities for the agency. Investors are about to get a lot more inside information about the defense sector. Among the companies reporting earnings results this week: Boeing, Lockheed Martin, RTX, General Dynamics, and Northrop Grumman. So where's the opportunity for investors? Well, Gursky recently upgraded Northrop Grumman and RTX to buy, in part on what he sees as compelling valuation for both those names. Brad, back to you.
All right, excellent breakdown, tracking the space here. Josh, appreciate it.
You got it.
Coming up, everyone, new Bank of America data. It takes a closer look at why women are playing a key role in a resilient consumer spending environment. We'll discuss that next on Wealth. Women are playing a major role in keeping consumer spending resilient, and that was the case throughout 2024. According to a new report from Bank of America, their median discretionary spending has been growing faster than men's for the past 2 years. Joining me now to discuss, we've got Taylor Bowley, who is the Bank of America Institute economist. Taylor, great to have you here in studio with us. Okay, so what are you noticing within the data, especially as we've just rattled off the stats about earnings growth, but then also the resiliency that we're seeing in spending among women as well?
Yeah, so that's right. I mean, the consumer has been resilient. We've seen that within our data, which we look at over 69 million consumer and small business accounts. So it's a pretty powerful data set. And what we've seen specifically in regards to women's discretionary spending is that for the past 2 years, it has been 20 basis points higher than men's. So you can think of that like spending going out to eat or going to the movies, traveling, those sort of discretionary things that we've really seen help support a lot of the economic growth over the past few years.
I mean, part of this also too is work on the part of organizations trying to make sure that they're doing their part to narrow the wage gap as well. There is still a larger inequity that needs to be narrowed and be eradicated, but how much of this is tied back directly to some of those initiatives that we're seeing to help increase wages as well?
Yeah, I mean, I think for me, one of the most surprising but also encouraging things that we've seen within our data is that there's evidence of a narrowing gender pay gap. And we see that because within median annual income for women, it's been outpacing men for the past few years when we look at that growth. And then additionally, when you think about, you're changing jobs, what we can see is for those that are changing jobs is the difference in that pay increase. Women's around 2% higher than men's and has hit a near 3-year high. So that's really encouraging and helping, because the money that you take home leads to more spending.
Right. So where is that spending going? What sectors, what industries are the biggest beneficiaries as a result of this new discretionary spending increase that we're seeing?
Yeah, so like I mentioned earlier, you can think about traveling, you can think about going to a concert, attending a sporting event. And so women are really helping drive that discretionary spending growth. And also when we think about women, when we think about strength, I would also point to the labor market, which has really been a tale of services strength over the past couple of years. It's just resounding services, which I would also say is women's strength, because what we see within our data is we can look at those sectors within our small business payroll and see that for those industries like health and education services that have a higher share of female employment, their payroll growth has been higher than the average trend over the past couple of years, really since the start of 2023.
There are a lot of these themes that really correlate and tie back into what we've kind of just summarized over the past couple of years as the she economy and women driving the economy either through spending, growth in labor force participation. What are the pillars that need to continue to take place in order for this to be a more long-standing trend as well?
Yeah, absolutely. I mean, those things you touched on, what we're seeing within our data in terms of spending growth, in terms of continued growth with that employment income. And, we're also seeing within federal data that women's enrollment in 4-year universities and the bachelor's degree program has been surpassing men's as well. And, more education leads to more opportunities and can also lead to continued strength that we're seeing in the U.S. economy.
Absolutely. Taylor, thanks so much for taking the time here with us today.
Thanks, Brad.
Appreciate it, definitely. You've got financial questions. Yahoo Finance has some answers here. One reader wrote into our senior columnist, Carrie Hannon, asking how they should be invested as a 79-year-old. We love this question so much, we're going to bring in Carrie Hannon and give the advice here. Carrie, you hear a question like this, break it down for our viewer and our faithful reader out there.
Oh, thank you, Brad. I absolutely love when readers write in and ask questions. And this one is actually a pretty good one because a lot of people, we are living longer lives. So, your investing days are not over at 79. Really, the best thing is for all retirees. So this is general advice because they don't give me every little nuance of the risk, how risk averse they are and so forth. But in general, retirees should have about 5 years of living expenses set aside in high yield bank accounts in cash and in high quality bonds. So, these are paying around 4.75% today for some of the CDs and the bank accounts. So this is a place where when the markets go down, you don't freak out. So you do not want that to happen. But one way to kind of take a look at things, and so that gives you your little buffer when the market shifts rapidly on you. But if you use an equation, which is just a standard one, but it seems to work, 110 minus your age is how much you should have in equities. So in this case, for my 79-year-old, about a third of his portfolio should be invested in equities, in stocks.
So, Carrie, you also responded to a reader who was trying to save up for a down payment on a car while also trying to pay down some debt. So which did you recommend that he concentrate on more?
Yeah, Brad, oh my gosh, this is so tricky because you want to put down a big down payment so that you have a smaller loan, but at the same time, you're taking on new debt. So without question, I didn't even hesitate when I had to answer this one. Please pay down your debt first. Make debt repayment priority number one. Interest rates on credit cards, for example, I wasn't sure exactly what kind of debt this individual had, but if it's credit card debt, my goodness, that's tough to get out from under. So I really encourage people to take a crack at that because your credit score is what's going to determine what your interest rate on that car loan is going to be. And a big part of your credit score is how much debt you have. So whittle away at that first. And it can be the interest rate that you are likely to pay if you have a poor credit score versus a stellar one, say 800, is about, triple the amount of the difference between what you might pay. So you need to pay attention to this first. Two methods people recommend for paying down debt. The avalanche method, which is you start at the highest interest rate and work your way down, or snowball, where you start with the smallest one and work your way up. Whichever one works for you, do it. Make paying down debt an absolute priority because that gives you the ability to really get the best interest rates moving forward. And also, just in general, it's incredibly liberating to be out from under some of that.
Yeah, I agree. Carrie, thanks so much. Appreciate it.
Thanks.
Coming up, is lying about money as bad as cheating? We're going to talk about financial infidelity. That's next on Wealth. Big sell-off day here on the markets that we're tracking. The Dow Jones Industrial Average not seeing the brunt of that. That's only down fractionally, but let's take a look at the Nasdaq Composite, where you're seeing declines of more than 3% right now. I've got this on a 3-month view just so I can pull up some candlesticks here for you and give you a sense of some of the other major down days that we've seen in recent weeks and over the past about 2 months here. Of course, you'll think back to mid-December. You'll also think back to early January, but this could be on pace to actually oust both of those. We'll be tracking that real closely here as we move on throughout the rest of today's session. Taking a look at the S&P 500. I'll put this back on a line chart for you here. We're taking a look at declines right now of just shy of 2% here. And where's it coming in from right now? Taking a look through some of the sector activity that we've been gauging here on the day as well here as I just toggle back on over to those sectors here. 11 of them. We've got them fired up here for you on the S&P 500. The biggest declines, to no surprise here, in technology. That's down by about 4.9% for XLK. Utilities also taking a leg lower. That's down by 4% here on the day. But there are some bright spots. Staples, that's been holding up throughout much of today's trading session and actually leading the pack here. You're seeing XLP, consumer staples, up by about 1.7%. But just to go back to technology for a hot second, giving you a look at some of the mega cap tech names. Hard to find some positive territory, but Apple is trying to at least make a case for itself after it's been in a state of decline over the course of the year to date as well here. You're just taking a look at year-to-date losses of 8.8%, but here on the day, it's up by about 2.5%. However, Nvidia down bad right now, 16, 17% in declines here. And now year-to-date, you're also looking at declines of about 11% for Nvidia. So we'll continue to track some of those mega cap tech names as we move on throughout the rest of today's session. Well, finances and infidelity are among the leading causes of divorce in the U.S., according to Forbes. And unfortunately, infidelity is more common than you think. According to a Bankrate survey, 42% of U.S. adults who are married or living with a partner say they've kept a financial secret from their significant other. Joining me now, we've got Ted Rossman, who is the senior industry analyst over at Bankrate. Ted, good to have you on the show with us today. Why do partners lie about money, and what do they lie about?
The most common form of financial infidelity is secret spending. And that's followed by things like secret debt, secret credit cards, and secret bank accounts. A lot of times people hide things because they feel ashamed about the way they handle money, or maybe just because they want more independence. That's something that's driving a lot of this among young adults who are more likely to have their own incomes. They're getting married later. Sometimes it's hard for people to mesh those money personalities, to which I would say you might consider the yours, mine, and ours strategy. That's something that about a third of couples are doing. So that means combining some of your money for joint expenses, but also keeping some separate for your own wishes and desires. The key is that you have to acknowledge how much is going into that separate account. That's why it's not infidelity if you have separation that you've agreed on ahead of time.
Okay, and so is there a good kind of rule of thumb that you believe or think most couples can strike when it comes to making sure that they're setting up what yours, mine, ours is in that whole conversation?
Sometimes it's a dollar amount. Maybe it's as little as $100 a paycheck or something like that. That's yours and yours alone. And you can use that for hobbies or nights out with friends or gifts or other things that you don't really want your partner questioning. Maybe it's more, maybe it's less. Maybe it's a percentage instead of a flat dollar amount. Whatever it is, you need to agree upon it. But really one of the keys here is that increasingly people are craving some sort of financial separation, even within a relationship. It's not like it used to be where a joint checking account kind of ruled the day. We actually see most couples nowadays keeping at least some money separate. It's about 6 in 10 overall, rises to about 9 in 10 among Gen Zers. So increasingly, there's some form of separation. You just have to talk it out. That's really the big key here. It's financial infidelity when it's a secret, and that can kind of take on a life of its own. You want to communicate with your spouse about money, and not just where it's going today, but also where you want it to go in the future. Get pulling in the same direction on those longer term goals, whether it's home ownership or retirement or paying off your kids' college or your own student loans or whatever it is. Frame it as far as the positive. What do you want to achieve with money, and how are you going to get there?
And then, Ted, I don't mean to throw Gen Z under the bus here, but I mean, hey, they're the generation that, according to the data, is the worst at this financial infidelity. Why do you think that is?
Gen Zers are still new to these relationships in many cases. We're talking here about people that are married or otherwise living with a romantic partner. But earlier in those relationships, that may contribute to some of these secrets. Also, the fact that people are getting married later, people are more likely to have their own incomes. A lot of young adults today also have divorced parents, and that may have colored their own relationship thinking as far as, oh, I'm going to keep this separate pot of money here in case the relationship doesn't work out. And I would just say that the secrets become problematic. It's hard enough to meet your financial goals when you're pulling in the same direction. It's that much harder if you're doing your own thing. It's important to communicate and figure out a system that works for you. And maybe it is keeping some or even all of your money separate, but you and your partner need to be on the same page about this.
Ted, let's switch gears while we have you. It is the first day of tax season after all, and we want to get your views on paying taxes with a credit card. What are the pros and cons of putting your tax bill on a credit card?
Some people might be tempted to do this to earn rewards, to which I would say we need to acknowledge the processing fee. The IRS has 2 approved payment processors. They charge surcharges of 1.75 or 1.85% when you use a credit card. So there's really kind of a minimal arbitrage opportunity there. Some credit cards give 2 or maybe even 2.5%, 3% cash back. Those are pretty niche though. I feel like you need to kind of hunt for a card that's going to give you better than 2% back. One time you might consider this for rewards is to get a sign-up bonus. You often have to spend a few $1,000s in the first few months with a new card to get the sign-up bonus. If you wouldn't hit it otherwise, but you would with a tax payment, maybe then the surcharge is worth it. I would not do it with the intent of carrying a balance though. Don't pay 20%, which is the average credit card interest rate. The IRS has payment plans if you do need more time. You can probably cut a deal with them that is something like 7 or 8% rather than putting it on a credit card and paying 20 or more.
Ted, thanks so much for taking the time here with us. Appreciate it.
No problem. Thanks for having me.
Certainly. Coming up, we have more helpful advice for tax season. We're talking to H&R Block's Vice President of the Tax Institute. Stay tuned for all the tips, tricks, and ways to successfully file your taxes on the other side. It's that time of year again. Whip out your calculators and gather those forms. Tax season 2025 is officially underway. The IRS expecting more than 140 million individual tax returns between now and April 15th. Here with more, we've got Andy Phillips, H&R Block's Vice President of Tax Institute. Andy, great to have you here with us. Happy kickoff to tax season. Take us through some of the top things that we should know about this tax season.
Absolutely. Hey, thank you for having me today. So let's just start with a couple big changes for this year that people need to know about. First, if you're one of the many folks who's maybe making some side money through an online marketplace, selling items on like an Etsy, or even selling like tickets on a StubHub, or if you're someone who takes payments through a third-party payment app, like maybe a PayPal or a Venmo, the threshold for receiving Form 1099-K this year has been drastically reduced, down to $5,000. What this means is a lot more people are going to get a 1099-K this year, many for the first time. That number, the number for which that is issued is going to go down even more in future years. So a quick look forward for 2025, which we're in right now, if you're doing business this year in a similar way, it's going to go down to $2,500 and down as low as $600 for 2026. So important to make sure you understand what does that mean to your taxes and ensure that you report it properly. For example, on the 1099-K, in the majority of instances, that full amount shouldn't be taxable. So making sure you're not leaving any money on the table when you get that. Another one, Form 1099-DA, is for those, those virtual currency, think cryptocurrency investors. Starting for this year, if you make trades on a platform in a virtual currency, you are going to get a 1099-DA for next year, starting in early 2026. That's really important because no one's received those before. But what hasn't changed is those transactions are always taxable. Just starting next year, the IRS is going to have more information on file because they're going to get that 1099 and be aware of that income as well. So making a plan for this year to make sure you've been reporting it properly for 2024 and prior years and for next year is really important. The last one, the child tax credit is a credit for working families to help make ends meet if they have eligible children, generally children under 17 that meet a few other requirements. That credit is a total of $2,000, but you per eligible child, you can get up to $1,700 of that $2,000, even if you don't owe any taxes. It's refundable. So that can make a huge difference for people.
And so talk to us about how AI is going to be incorporated into this tax season. I mean, is it going to help me go through my taxes quicker?
Absolutely. So what I want to talk about today with that is H&R Block, first last year and again this year, we launched what is called AI Tax Assist. So that's a generative AI powered, think about it like a conversational support tool that you can use in our do-it-yourself products to ask questions and get specific answers to your situation. And then the beauty of it is, one, it's going to give you really helpful advice. Maybe you say, hey, that was super helpful, but I still think I need the help of a human. While you can get that AI Tax Assist at no additional cost in any of our paid do-it-yourself products, you can also chat with the human. If you're like, hey, that was really helpful, but I still need that human touch, we've got you covered no matter how you want to get that help.
And then just lastly, while we have you here, what are some of the common tax scams that people can avoid this tax season?
Yeah, I'll talk about two. So first, let's talk about identity theft. The unfortunate reality is that, identity theft is just at an all-time high. With the, just the ubiquity of, or just the constant nature of breaches, our information is out there. And one way you can help protect yourself from being a victim of tax-related identity theft is to file early. The earlier you file, you prevent fraudsters who may also have your information from filing in your name. It is a really big process to get that resolved when you become a victim. So an important way to try to avoid that is to file early. That also helps you if you're due a refund, get those refund dollars as early as possible. Another thing we've really seen coming up the last few years is online scams from promoters, particularly on social media, promising what look like just too good to be true tax opportunities. Maybe a credit you've never heard of, maybe a credit that it doesn't make sense that you would qualify for, but it seems like a really large credit or a really large deduction. In those instances, it's really important to get the help you need and make sure that you're not making a mistake that can cost you in the long run.
Absolutely.
For instance, if you file a tax return claiming a frivolous tax credit, you can face up to a $10,000 penalty. You may face criminal action. And so it's really important that you're not relying on social media for your tax advice. Make sure you're going to a credible source. For example, at H&R Block, we have our online tax information center on our website, full of good content that's been fully reviewed to make sure you're getting it right. You don't want to claim something unless you're really sure that you're eligible.
Andy Phillips, thanks so much for taking the time. We'll check back. We got to get a barometer of how well tax season is going later on.
Absolutely. I'd love to do it. And thank you for having me today. Happy tax season.
Happy tax season. Coming up, we're talking the latest housing data and a major threat to the condo market. That's on the other side of this break.
Welcome to Yahoo Finance Sports Report, a unique look at sports business brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano, and I'll be breaking down the financial side of the game for your financial gain. We'll go beyond the headlines, analyzing all the latest sports news, the teams, the trades, and billion-dollar deals, so you and your portfolio will win big. Catch Yahoo Finance Sports Report on Thursdays on all your favorite podcasts and streaming platforms.
A programming note, in this week's episode of Financial Freestyle with Ross Mack, Tanya Van Court, founder and CEO of Goalsetter, shares the company's core mission of transforming kids from spenders and spenders of money into savers and investors of money in a fun and engaging way.
My mom was an elementary school teacher in Oakland, California, and at Goalsetter, we are an education-first finance platform for kids. It is all about how do we transform your kids from senders and spenders of money into savers and investors of money, and do it in a way that makes it exciting and fun and engaging for them. As you know, Ross, my background is that I actually come from Nickelodeon and Discovery Education and ESPN. So I had many, many years of honing this skill of creating gamification, entertainment, education, and putting all of that into really fun and engaging apps for kids and families.
You can catch new episodes of Financial Freestyle. They air Mondays at 12 p.m. Eastern Time. Catch them on Yahoo Finance or wherever you get your podcasts. December new home sales rose by 3.6% from the previous month, coming in just above estimates for a total of 698,000 homes. For the second straight year, the new home market had more sales activity, rising 2.5% from 2023. Here to break down the results, we've got Yahoo Finance's senior housing reporter, Danny Romero. Hey, Danny.
Brad, the new home market ended 2024 on a high note. Buyers took advantage of builders' incentives. The annual pace for new single-family homes rose 3.6% last month. And for the full year, buyers bought 2.5% more homes than 2023 levels. Builders like D.R. Horton have been sweetening the deal for buyers to get them off the sidelines. And the most popular incentive for these builders has been the mortgage rate buydowns. That's when the builder upfronts the cost to lower the rate on the loan. And these incentives aren't going anywhere because mortgage rates are hovering around that 6.9%. So they're still trying to incentivize more buyers. Now, buyers are still dealing with high home prices. The median new home price clocked in at $427,000 in December. That is 2.1% higher from the previous month. Brad?
All right, Danny, thanks so much. Appreciate it. 74 million Americans live in condos or other communities that rely on homeowners association insurance to cover communal areas like sidewalks and playgrounds. One problem, that insurance is getting more expensive and harder to find. Here with more in the full breakdown, we've got Yahoo Finance's Claire Boston. So Claire, what's behind what's taking place in the dynamics here?
What's really interesting is that we are seeing kind of what we are seeing in the single-family home market. It is just getting harder to find insurance anywhere. And as a result, in the condo market specifically, it's getting a lot more expensive for HOAs to insure what we call like a master policy. So that's anything public spaces. That's your roof, that's your sidewalk, and it's causing an increase in HOA fees for people who live in those communities.
So how is this impacting the overall condo real estate market from what we've seen?
You know, it's early days, but we are seeing signs that the condo market is a lot weaker than the single-family home market. And generally, that is because these fees are rising so quickly. Condo sales through the third quarter of last year were down about 5.5%. That's according to Redfin. And the listings are up 27%. So that really shows that the stuff on the market in the condo space is lingering. And people really have a preference for single-family homes because of those fees.
Yeah. Claire, thanks so much for tracking this, an important dynamic as well as we're seeing play out, especially with the reliance on insurance right now, and you know, for the entirety of history. Yeah. All right, let's do a quick check of the market here as we're taking a look at the major averages. We've been seeing a sea of red for the Dow Jones Industrial Average, the S&P 500, the Nasdaq. They've been in negative territory. The Dow down by about 0.1%, but then take a look at the Nasdaq. That's down 3.25% right now. The S&P 500 that's lower right now, led by tech in those declines right now, as 1.9% in declines are being seen as we go into the lunch hour, as it's commonly known here, Eastern Coast time. And then additionally, taking a look at I was taking a look at XLK on my screen. You're seeing much of the declines being led by XLK, as the sectors right now are still mixed, but you're seeing technology and utilities lead the leg lower here today. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination. That comes up 3 p.m. Eastern Time. Josh and Julie will count you down to and through the closing bell.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is Market Domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.